we had, I think, a really exceptional day on Friday. That's Friday, and you can see we have 4 bars with lows below the moving average, and 99.5% of days have at least 3 bars with lows below the moving average. But 99.5% of days also have at least 1 close below the moving average, and we did not have one yesterday. And I checked back, and I only found one other day in the past 10 years where there was no close below the moving average. It was about 3 years ago. So even though I say 99.5% chance of a close below the moving average, it's probably more like 99.8%. There are about 200 trading days a year. And anyway, yesterday, Friday, did not have a close below the moving average. In fact, it did not have a reasonable stop entry sell signal at all during the day. I don't think that's good enough. So, and there were clearly no stop entry sells on the way up. So it's a really pretty unusual day. Now, we know a few things. First of all, when you have a strong trend day like yesterday, there's a 50% chance you're going to get some follow-through buying on the open in the first hour or so. Looks like the bulls might be trying to do that here. And okay, now we know where the open of the week is, so I'll put that over there. I always pay attention to the open of the week, and it's the open of the day. And later in the week, traders will start paying attention to the open of the week. This is around a 50% retracement of Friday's rally. Here's Friday's low, Friday's high, here's 50%. So we're right around a 50% retracement of Friday's rally. And below, we also have the Globex low as a magnet. Right now, we're in the middle of the Globex range. And we know 90% of the time, we either break above the Globex high or below the Globex low. This is a pretty strong reversal up. This is the 15-minute chart. And right now, I would say it's equally likely we'll go above that as it is that we'll go below this. And obviously, the more big bull bars we get, the more likely we go above this. We had a spike pull back down, 3 legs, 1, 2, 3. And the market tends to get back to around the beginning of the channel phase, which is where we are right now. And then it tends to pull back and form a trading range. So there's an increased chance that we'll go sideways here over the next hour or so. And whenever you have an exceptionally strong bull trend like Friday, the next day, 75% of the time, you're going to have at least a couple hours of sideways to down trading that starts by the end of the second hour. So, and it might have begun now. We have big up, big down. That tends to create big confusion and leads to a trading range. Do you buy above 1? Well, let's see what it looks like. There's room to the moving average. There's room to a 50% retracement from yesterday's high. So, if 1 closes on or near its high, it'll be a credible buy, but it probably will not turn out to be a swing. Big up, big down, big confusion. When you look at this, you say, wow, after that strong trend, I wasn't expecting this much of a pullback. And a lot of the bulls feel that way. So there's confusion and hesitation, and that increases the chances that we will have a trading range open. Simply having a small pullback trend day yesterday, Friday, is enough to make it 75% likely that we're going to have at least a couple hours of trading range trading today that starts by the end of the second hour. So the bulls are trying to get this to bar 1 to close on its high, and then they'll try to get up to yesterday's close and yesterday's high. And the bears are hoping we form a lower high and begin a channel down. So a gap down spike, pullback, and then second leg and third leg. Chances are we're not going to reverse most of yesterday. It was such an exceptionally strong day. Sometimes you'll get an exceptionally strong day up and then one down, but that's what yesterday was, or Friday. We had a strong day down on Thursday and a strong day up on Friday, so we've already done that. I doubt we're going to have another big bear day. So today is probably going to be either a trading range day or a bull trend day. And with this big gap down, it increases the chances of a trading range day. When I talk about today and yesterday, the bars to the left of the dashed line is yesterday. Because if I look back on the chart, over here somewhere, I don't know if this is a Monday and it's a Friday, so I call this today and that yesterday. So when I use yesterday, I'm referring to trading days, not calendar days. Bulls, a good bull bar, but a fairly prominent tail. We're probably still always in long, and the math is okay to buy above one, but it's confusing, and confusion usually leads to a trading range. So, I did not buy above one. A lot of times I'll wait for two consecutive trend bars in the same direction. So if we get two consecutive bull bars where one of them is big and closing as close as near its high, then it is by the close. And bar one is big and it closed near its high. So if two is even a small bull trend bar, it qualifies as a by the close setup. But you're right below a 50% retracement and right below the moving average. So if you take a buy like that, you have to be hoping that this is going to be a bull trend from the open. It probably will not be, but that's the only reason to take the trade. You're hoping it will resume Friday's trend and just go straight up. So it's a low probability bet. What happens if two is a really big bull bar closing near its high? Well, that would increase the chances that we're going to go above yesterday's high in the first hour today. But why did we have such a big gap down? That generates confusion, and it reduces the chances that this is going to be a big bull trend from the open. Increases the chances we're going to have a trading range open, and that increases the chances that anything bullish is not going to lead to a bull trend, and anything bearish is not going to lead to a bear trend. You get a bet on reversals. The bulls are going to try hard to get a bull body, even a one-tick bull body. Even a perfect doji would be a bar that looks like 38. That would still be follow-through. The one thing they don't want is a bear bar. Okay, this weekly chart is, the data is messed up. Let me turn it to a daily chart and back to a weekly chart. Okay, now it's fixed. We've had a pretty sustained rally on the weekly chart, and we'll probably get a pullback soon. There are a lot of really interesting things going on right now. Daily chart. Friday opened around Thursday's open. Thursday sold off. So every bear who sold on Thursday and held had a loss on the open of Friday, and those bears bought back shorts all day long on Friday, and that's part of the reason why Friday was a big bull day. And typically when you get a day like that, a big bear day, and the next day a big bull day, and they open around the same price, it takes a few days for all the bears to give up. So you typically get follow-through buying. So chances are, even if we pull back for a day or two, we'll probably go higher. Also, I've been talking about this triple top end of April, early May. Really three impressive bull days, all failing around the same price. So I think we're going to get there. Again, we could pull back for 2 or 3 days at any point, but I think we're going above this blue line. I think we're going to reach the bear trend line from January down. We're very close to that. So I think that's where we're headed, 4,300 area around here and around that bear trend line. This 50% pullback of the year-long or the bear trend of 2022, we may oscillate around there for a while. I've been saying we should fall below the June 28th high and that the year will turn into a trading range. or at least we'll test back down here. I think it's less likely now. This is a pretty good rally. I do think we're going to pull back below 4,000. And I should put a line there. I do think we're going to pull back below 4,000 because it was such an important price last year. Okay, over here at 4,000, we gapped up on the daily chart, the weekly chart, the monthly chart, and all the other big round numbers we oscillated around 3,800, 3,900, 4,100, 4,200, but 4,000 we just jumped above it. And we've been testing it now for several months, and I think we'll probably come back down and dip below it. I think there's a better than a 60% chance we've seen the low of the year. I've been saying since December that I thought we'd sell off for at least a few months in the first half of the year and rally in the second half of the year and try to get back to the high. We sold off more than I thought we would, but we're rallying so far in the second half of the year, and I still think that's likely. And this would be a target. You know, the bears might get a double top here. If we get up here, they'll try to get a double top. But right now, I think we're going to be in a trading range for many months, 6 months, a year. The top of the range might be here. The top of the range might be above that. But I think for the next year, we're going to be in a trading range. It's possible that we get below here. I think there's less than a 40% chance we'll get a new low. And I think there's a 30% chance we come all the way back down to the pre-pandemic high, the high before the pandemic, around 3,300. I can see on my other computer that we had a bull bar. So we had consecutive bull bars, one big closing near its high. So it's by the close, and I did not buy the close because I did not want to buy too close to the moving average after big up, big down. We're probably going to get a trading range. Can you be long here? Can you buy the too low? Yes and yes, but where's your stop? Is it below 1? You probably need a wider stop, probably a stop way down here and scale in. So I think it's better to wait for a second buy signal or a second sell signal. So I would not do anything right now. You can see probably more buyers than sellers below 2. For the bears, big gap down. They hope it's a bear trend. They think of 2 as a low 1 sell. But I think we're always in long. We have consecutive bull bars. Chances are traders are going to buy the 2 low, the 2 close, the 1 close, the 1 high. But will they buy much higher? That I suspect that we're going to stall around the moving average. Maybe where we are here. There probably will be buyers below 1 around the Globex low, which is right down here, and there'll probably be sellers around the moving average and around yesterday's close and yesterday's high. On that daily chart over here, I want to add something. Okay, 4,000 big round number. I do think we're going to get there in the next few weeks, and I think there'll be buyers around 4,000. So I'll put that there on the daily chart. So we're going to reach the bear trend line, possibly in the next couple of weeks, and we're going to reach the 4,000 big round number maybe in the next month or 2. Now, I said I was not willing to sell the first reversal down, but the second reversal down, if 4 is a bear bar closing near its low, that would be a credible short. It's probably not going to be a bear bar closing near its low. Right now, the bulls are wondering, are we going to break above 2 and rally for a measured move up to yesterday's close and yesterday's high? So I'm not going to sell below 4. It's still on the buy above 1, buy the close of 1, buy the close of 2, buy the low of 2, but the location is bad. So, most traders are better off waiting for things to become more clear, but I do think the math is okay to be long. I don't think it's especially good. I want to make another point. Well, daily chart's really crowded. Let me do it this way. Okay. I'll put up a weekly chart to make my point. There are a lot of traders who like to buy 10% pullbacks, and that's why you sometimes get the market selling off sharply down to 10%, and then it rallies. Other traders buy 20% pullbacks, so sometimes you get a big sell-off to 20% approximately, and then it rallies. And then other traders buy 30% pullbacks. They have limit orders, or they buy the market, or they wait for it to get there and reverse up. So 10, 20, and 30%, 40%, 50%, they're all important magnets. And you'll notice that a lot of sell-offs, like I think this was 10%, 10%, 10%, a lot of sell-offs end at 10% or 20%. Because people like me buy there, because chances are, it's the market's being marked down. Another 10% pullback, another 10% pullback. The market's being marked down, and you don't get discounts that last long. Here's an example of where it was 10%, 20%, and then it fell 55%. The bulls hoped it would hold it at 20%, and it collapsed down to 55%. Most of these traders who are buying 10, 20, 30% down are hodl type people, hold on for dear life. They're not going to exit. So they held through this knowing that we were going to get a new high probably within a year or 2 or 3, because that's what always happens. And that's why you have these traders, anytime it's down 10%, people with cash in their accounts, they'll buy. Down 20%, they'll buy. And so here, 10% they bought, but they didn't buy higher. 20% they bought. And, this may be the end of it. So that's another reason why this is an important support zone. We had that gap back around 4,000, below 4,000, and then this, and we're getting near a 50% retracement of that. So the rally. So here's the big rally, and did not quite get to 50%. And here's the pre-pandemic high. I do not think we'll get there. I do not think we're going to get here. We might get there after we test here or here, but I do not think we're going to get there before we test higher. Bulls trying to get a breakout. A bull breakout is a bull bar closing near its high with an above average size body and a close above the high of the prior bar. And this is a bull bar, a decent sized body, not all that big, but it did not, it closed at the high of bar 3, and it did not close on the high of the bar. So it's not really, I would not call it a breakout. Obviously, this was a breakout yesterday. It's a big bull bar, closed near its high, and it closed above the high of the prior bar, and it closed above the high of the past 50 bars. That's a breakout. This is a little breakout, closed above that, closed on the high of the bar. This is a breakout above that, but it closed below. But then we closed here above the high of this bar and above all the highs of the day, and we had a bull follow-through bar. Still on the buy, above 1 or on the close of 1, but some hesitation 4. Bulls, I'd get out a tick below a bear bar. I'd get out maybe 3, 4, or 5 points below a bull bar. And for the bears, they need a decent bear bar to short. I would not short yet. A lot of the bulls who bought above 1 will scalp out with around 10 points. So there'll be some bulls selling around here. They might wait for a test of yesterday's close or yesterday's high. These tails indicate bulls taking profits, hesitant, not confident that we're going all the way up. I think we're so close to yesterday's close and we're getting persistent buying 4 of the first 5 bars were probably going at least a little bit higher. You have the 10-point bulls. So a lot of the bulls who bought 1 or 2 hoped for a quick move up, like yesterday, 60-61, but they're disappointed bear bar 3, tail 4. So some of them will scalp out right here, 10 points above the high of 1. So there may be some profit taking here, also around the close of the day. We're going to go higher. Look at where we are on the Globex chart. We broke strongly above the start of this channel, and we're very close to the Globex high. So we should get above the Globex high, which means we should get to yesterday's close and maybe yesterday's high. What are the chances that today will be another small pullback bull trend like yesterday? I still think only 25%. So I still think there's a 75% chance we're going to have some trading range trading for a couple hours that starts by the end of the second hour. Okay, we're at yesterday's close. We just went above the Globex high. Very good, very big bull bar. We have consecutive bull bars, with one being big, closing on or near its high, 4 or 5. So it's again by the close. Risk is big. You're going to put a stop below 3 or maybe a few points below 5 or below a 50% retracement of 4 or 5. So that would be down here. So I think of this as more a profit-taking zone for the bulls who bought above 1 or 2 at the Globex high at yesterday's close. So we might get a little bit of profit-taking here. But a big enough bull surprise will probably get at least a small second leg up. So even if we get a bear bar 6, that would be a low 2, 2. I think it's not, I would not short it. Bulls, they should get out below a bear bar closing below its midpoint. But for the bears, I'm not willing to short below 6. I talked about how when yesterday's a climactic day, 25% of the time you get follow-through buying on the open, but 75% of the time, by the end of the second hour, you'll have at least a couple hours of trading range trading. So here's a very strong by the close bull trend day, and here's the next day. So 25% chance, well, 50% chance you get strong follow-through buying, 25% chance the trend lasts all day. So you got the follow-through buying and then the trading range. Fairly strong. We were sideways here for a couple hours, but it was still only a small pullback bull trend. So 75% chance we'll have at least a couple hours of sideways to down trading, and here it lasted all day. Very strong bull trend, big gap up, follow through buying. 50% of the time you get follow through buying, and then by the end of the second hour, you'd expect a couple hours of sideways to down trading. And here we sold off. Big bull trend day. Today, 50% chance you get follow through buying, and 75% chance you have a trading range. It still was a small pullback bull trend day, but we had a couple hours of sideways trading. Now I want to scroll down here. Here we had almost a couple hours of sideways trading, but it was really a second really strong bull trend day. Another example, 19 bars, not 24 bars, not 2 hours. Very strong day yesterday, and today became a pretty strong day today. So 25% of the time, the second day will also be a strong bull trend day. Bulls are hoping it's a bull trend from the open. They're hoping we go up all day, gap down, and rally all day. In general, 20% of the time, you'll get a strong bull trend on the open and it'll last all day. 20% of the time, you'll get a strong bull trend that will reverse. And 60% of the time, if you get a really strong bull trend on the open, it'll evolve into a trading range, usually by a couple hours into the day. Okay, we broke above yesterday's high, which is also last week's high. I'm going to change the color. It's not only yesterday's high, it's last week's high. So we've reached the targets that I had for today. I get to that high. It's really, this is the highest of the highs, so I'll put that over here. This is a 4-hour chart, and that's the April 28th high. And I think that's where the market is headed. But as I said, we may pull back for a week or two before we get there. Can we get there today? It's pretty far up. It's possible we get there. We got to get about 4,300. I don't know. And trading range is likely. So at the moment, I think we're probably not going to get there today. But I do think we're going to get there. Maybe tomorrow, maybe within a week or two. Remember, I think we're going up to 4,300 because of we have a cluster of things going on there. We got the bear trend line, which right now is around 43.70 or something, and then we have these highs, and this is the highest of the four, April 28th. So I'll mark that. So yeah, we're going higher, but it may be we may be too overbought to get there without pulling back first, which is what I think. I think we're probably too overbought over the past several days and the past several weeks to continue up to that bear trend line without first pulling back. Okay, so here we have a higher high double top with yesterday's high, a low 2 with bar 2, but in the first 6 bars, we only have 1 bear bar. So I would not sell, I would not go short below 6. Bulls, it's reasonable to get out 3 or 4 or 5 points below any bar, below bar 6. Some bulls will buy the 6 low, but it's different from buying the 2 low. The 2 low, I think, was a high probability buy because we had a lot of magnets above. Now, this is a second attempt to reverse down, and we're at the magnets, so there's less incentive to buy. Plus, we're in a good target zone for the bulls who bought here. So you have bulls who bought here exiting in this general area, and so there'll be fewer bulls willing to buy below 6. What happens if 7 is a bear bar? Can you sell below 7? I still would not, because you'd be selling right at the moving average and around a 50% pullback. So I would wait for maybe 2 or 3 bear bars, or for it to go sideways for a few bars and form a micro double top, or go up a little bit more and form a wedge, 1 pullback, 2 pullback, 3. So for me, it's too early to short. Bull surprise 5, probably at least a small second leg sideways to up. For the bulls, it's a high 1. They're hoping 7 is a breakout test, 4. But a buy climax 5, so it's the market reaching up to resistance. That attracts profit takers 6 and 7. It reduces the number of bulls who will buy above 8. They don't want to see the market race to a resistance level, last week's high, and then stop. I'm going to get rid of this 50% retracement. I don't want too many lines on the chart. That's a 50% retracement of yesterday's range. Get rid of that. Back to a 5-minute chart. So it's a high 1, but it's a bear bar. Big tail 6 at resistance, yesterday's high, last week's high, and a buy climax 5. And we know Friday was an exhaustive buy climax day, and that therefore today we'll enter a trading range at some point by the end of the second hour, 75% certain. So all of those factors reduce the number of bulls buying above 7, and you probably will start to get bears selling above 7, betting on a parabolic wedge or a nested double top 6, bigger double top, yesterday's high, 78. So what do you do here? Okay to take profits if you're long. You have 10 points profit. I think that's okay. Or take partial profits. You can get out below 7, or you can get out a couple points below 7 if you're long. And for the bears, I still think it's too early to short. They might sell with a limit order 7 high or 6 high and bet on a wedge. I talked about 7 being a breakout test of 4, so you look for a measured move up. But we've already had it. Okay, that measured move is exactly at the high of the day. So a lot of the computers had limit orders to take profits at that measured move. Now I said 7 is a bad buy. What happens if 8 is a bull inside bar closing near its high? That would be a better buy. You'll get more bulls buying. But smart traders know that there's only a 25% chance this is going to continue up all day, right? Smart traders know that yesterday was a buy climax, and that greatly reduces the chances of today being a second consecutive strong bull trend day. So if it's not going to be a strong bull trend day, there will be fewer traders willing to buy near the high of the day. Traders want to buy, but they're more interested in buying pullbacks. And 7 might not be enough of a pullback. If you buy above 7, you're buying very close to the high of the day. Can you sell the 7 high and scale in higher, 10 points higher, 20 points higher? You probably would make money, but I would not do that. That's not the most effective way of trading. I would wait, if it goes above 7, wait for a reversal, and then look to sell if you get a decent sell signal bar. Buy the close bulls 5, disappointed 7, and that's why the high of 8 is around the 5 close. Bulls have bought the close of 5 or above 5. They see 7 and they think, maybe it's not going to continue up as a big bull trend. Maybe I'll try to get out around break even. And that's why we sold off from the high of 8. It's right around the close of 5 where the bulls bought. This is a high 1 in a strong rally, but it's 2 consecutive bear bars at resistance, yesterday's high. So there probably will be sellers not far above 8 or above 6. So I would not buy above 8, even though it's a high 1 in a very strong rally. What happens if 9 and 10 and 11 are bull bars? At some point, you have to buy again. At some point, you have to say, it's going to be like yesterday, just a really strong bull trend day. So if it starts to look more like yesterday, at some point, you have to decide it's like yesterday. And then you place an order to buy above a bull bar closing near its high, above that bar, above that bar, above this bar, above any of those bars. Can this be the high of the day? Absolutely. Remember, I said 50% chance we would get some follow-through buying in the first hour, which we have. I've said 75% chance we're going to have at least a couple hours of sideways to down trading that starts by bar 24. It's possible that this is the start of it. We have a double top with yesterday's high. Now I said at some point you have to buy again if you keep getting bull bars. At some point you have to short. And you sell below 8, a low 1, and what the bears hope is the start of a bear trend? I would not. What about 9 if we have 3 consecutive bear bars? If we start to get 3, 4, 5 bear bars, you'll get more and more bears willing to sell. 8 is, I think, an interesting bar. You got to buy the closed bulls 5, disappointed 7, and they were able to get out around break even 8. So that increases the chances that this is the high. The buy the closed bulls 5 were able to exit. And those who did not take the opportunity to exit when they could might panic out of longs and we could get a give-up bar, a bear surprise bar. So if 9 is a big bear bar closing near its low, that would represent more and more bulls panicking out of longs, deciding that instead of a bull trend, it's a bull trap, and that we're putting in a high of the day instead of the start of a big bull trend. The close of 9 is important. The bigger the bar is, the more it closes on its low, the more that would be a sign that the bulls are giving up and they're deciding that this is the high of the day. Usually, the high of the day will come from a decent sell signal bar, and 6 is not a decent sell signal bar. So it's still more likely that this is a pullback in the bull trend than a reversal into a bear trend. Also, you look at the 15-minute Globex chart and look at that rally. It's unlikely we're going to go that far up and then straight down. More likely we would have to transition into a trading range for several bars before the bears can get a bear trend. This is a 15-minute chart. Several bars means about an hour. So on the 5-minute chart, it's unlikely we'll go straight down into a big bear trend without going sideways. The bottom of the trading range might be around here. It could be around a 50% pullback. It could be around the 4 high. There will be some limit order bulls buying at the 4 high, betting it's a breakout test, a pullback to the breakout point, the 4 high, and that will continue up. That's very common. Yesterday, small pullback bull trend, you keep getting breakout tests, but the limit order bears keep getting screwed, right? They sell at the 19 high, they sell more higher, and they expect to get out break even at the 19 high. Well, guess what? It doesn't go below the 19 high, and the bears have to cover for loss. And then they sell at this high, sell more higher, hoping to get back to that high, and it does not. It keeps going up. So we're getting gaps all the way up. And when you see that, the bears are, you just know the bears are getting slaughtered. The limit order bears betting that will dip below the breakout point, and it does not dip below the breakout point. You know, when you see that, when you get a couple gaps in the first, early in the day, first 10 or 20 bars in a trend, it increases the chances the trend will last all day. And we had a gap here, 29 and 19, and then we had another gap here, 39 and 26. And at that point, you got to be thinking, this is going to be one of those days that remains a small pullback bull trend all day. And therefore, do not sell. All right, so is this buy the close or sell the close? Is it the bulls panicking out of longs? Don't know yet. I would be flat here. I'd get out below 8 or below 7, or 3 or 4 points below 6. And then for the bears, not a good stop entry, sell below 6 or below 8. So I would not short. This is a 50% pullback. It's a breakout test of 4, even though we dipped below the 4 high. You had some bears that sold the 4 high, sold more 5 points, 10 points higher, and now they're buying back their shorts. So we may bounce here around that 4 high. Is it bearish enough for a lot of bears to start selling closes? Right now, it's more likely a 50% pullback of the day's rally, a test of support, the 4 high and the moving average. So, I think it's probably better not to short yet, even though it's 3 bear bars. I think, as I said on the open, we should be thinking trading range starting at some point in the first 2 hours. And 3 bear bars and a double top, it increases the chances that the trading range has begun. The trading range could be tight, small, and sideways for a couple of hours. It could be broad. We could come down to a new low and then get big legs up and down. It may not have begun. We may go to a new high and then get the trading range. But it looks like the trading range has started. Disappointment, confusion, hallmarks of a trading range. Bulls were excited by 5, happy followed through 6, and then disappointed 7. And now they're confused. Have we begun a bear trend, or is it worth buying above 10 for a high 1? I do think there probably are more buy the close bulls buying here than sell the close bears selling. So I think we'll probably try to bounce. But it's a high one above 9. Nobody's going to buy above 9. Bulls are hoping for a bull bar 10. Bull bar closing near its high, closing above the moving average. And some bulls will take that buy. Others will say, nah, it closed the gap above 4. You got 3 bear bars, one of them big closing on its low. I'll wait for a second buy. Just like at the top, 6, I said that most stop order bears would not sell below 6. They'd wait for a second sell. And most stop order bulls are not going to buy above 10. They'll wait for the market to go sideways for a few bars and form a micro double bottom. Remember, if this is a trading range, we're probably in the middle. And in general, that's the worst place to do anything. Trading range, you buy low, you sell high. You don't buy or sell in the middle. So best choice here, wait. If it goes up to 6 and sells off a second time, it's a sell. If it goes down to 1 and rallies a second time, it's a buy. If we go sideways here for a few bars and get a micro double bottom, it would be a buy. Consecutive bear bars, 9, 10. One of them big, closing near its low. So theoretically, it'd sell to close, but we're around a 50% pullback and probably around the middle of a trading range. That will reduce the number of bears selling. But right now, this is sell to close, and I would say it's always in short. We have consecutive bear bars closing below the moving average. We have 4 consecutive bear bars, but a trading range is likely, and we might be in the middle of that range. So I think it's not a high probability short. In situations like this where you know it's a short, but the probability is less and the risk is big, one way of handling it is to put on a small position. And I talk all the time about having 2 position sizes, your normal size and then a second size that is only 20% of your normal size. If you normally trade 1 E-mini, that's the same as 10 micro E-minis. A 20% position size would therefore be 2 micro E-minis. So if you trade normally 1 E-mini and you look at this and say the math is really not good enough for me to risk what I have to risk, but I do think we're going lower, so I'll trade 2 micro E-minis, and if it bounces, I'll sell more 5 points, 10 points higher. And if it keeps going down, I'll sell more if you start to get a series of bear bars. So you sell, planning to sell more higher, planning to sell more lower, and build up your position. I think most traders are better off waiting. To me, it looks confusing. And when things are confusing, I usually don't like to sell near the bottom of anything, a leg down, and I don't like to buy near the top of anything, a leg up. Because when things are confusing, traders take quick profits, and that results in reversals. They don't want to sell at the low of anything. They want to sell high. And so they sell high and they scalp. And they want to buy low. We're low right now. So I think there will be more buyers than sellers here. So I would not sell the close. For the bulls, it's a wedge bull flag, 3 legs down, 7, 10, and now 11. They want a good buy signal bar. But after 4 bear bars, most bulls are not going to buy above 11. We're getting near the end of the first hour, so traders are deciding what the first 60-minute bar will look like. We had 8 consecutive bull bars on the 60-minute chart, 7 yesterday, 1 on Thursday, and the bulls are trying to get 9. If they get a bull bar, they want the bull bar to close above the midpoint. That increases the chances we'll go sideways to up. If there's a bull bar, the bears want it to close below the midpoint. That would increase the chances we go sideways to down. Now, this is a streak of 10 consecutive bull bars. That's a lot. Look back here. How many? We have a very strong bull trend. Okay? Very strong bull trend. And how many times did we have 10 consecutive bull bars? Here, what do we have? We had about 10 here. 3, 4, 5, 6, 7, 8, 9, 10. We got 10 and then that. And right now this is 10. And remember I said today has an increased chance of a trading range day. Here we had 10 bull bars and then sideways. So there's an increased chance today is going to look like this, you know, a rally and then sideways. 5 consecutive bear bars. It's sell to close since 10, but a trading range is more likely than a sustained bear trend. 5 consecutive bear bars. How many times do we, in this streak, did we have consecutive big bear bars closing near their lows? 0. So that reduces the chances that this is going to continue down indefinitely. Bulls are hoping, bears are hoping, strong rally, high of the day. 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 Here we rallied for several hours and then reversed down. Strong rally, second leg up, high of the day. Sustained rally for the first half of the day and then sell off. Strong rally, high of the day. The bears are hoping, strong rally, high of the day. Parabolic wedge, a tight channel with 3 legs down. It doesn't look like a wedge on this time frame, but it is. We're down, pause, down, pause, down. So if I look at a smaller time frame chart, we'll probably see it. Let me put up a 1 minute chart. And you got 3 legs down, 1, 2, and 3 in a tight bull channel, spike pullback channel. Typically the market will try to get to the start of the channel up here. So that's probably where we're headed. I don't know if we're done going down. We may go down here, but right now the bulls will try to get back up in this area. Back to a 5 minute chart. Can you buy above 12? With 5 bear bars, it's better to wait for it to stop going down, begin to go sideways for 2, 3, or 4 bars, and then buy. So there will be sellers above 11, and if we do reverse up here, it'll probably be only for a bar or 2, not a very good buy. 15-minute Globex chart, very strong rally, unlikely to become a bear trend without first converting into a trading range. And look at where we are. What happened at that price earlier? We did that. So increased chance that we're going to do that again, that we're going to start to go sideways around where we are. Unlikely that this is going to become a bear trend without going sideways. It's unlikely that a big bear bar like that is going to go right back up. So unlikely we're going to go immediately up. Unlikely we're going to go much further down, and that leaves us with sideways here or soon. You can see nobody wanted to buy the high 1 above 11. They sold it. It's like nobody wanted to sell below 2. They bought it. The bears have sold the 11 high. Are they expecting this to be a small pullback bear trend that lasts all day? No, they're expecting a trading range. And that's what I've been saying since the open. Yeah, we might get follow-through buying on the open, but we're going to enter a trading range. It could begin on the open, but 75% chance it'll begin before bar 24. This is bar 12, the final bar of the hour. So it affects the appearance of the first bar. I said the bulls would like the first bar, the first 60-minute bar, to close above its midpoint. And that means the midpoint of this first hour is a magnet. And here's the midpoint. So do you think the computers are thinking this way? Yeah, you bet. The computers are very much aware that we're not going to close at the low of the hour. We're not going to close at the high of the hour. And therefore, the fight is over the middle of the hour. And here we have 1 minute left, and look where we are. Exactly at the middle of the first hour. Well, the bulls are high 111. Bear bar, not a good buy. Some bulls might buy above 12, but I would not. After 5 bear bars, most bulls will want a micro double bottom. 6, a bad sell signal bar. So we're going back to the 6 low, possibly right here. We might pull back first, but we should get to the 6 low. Why is that? You have a bad buy signal bar, so some bulls will buy at the low of the bar and scale in lower, 5 points, 10 points, 15 points lower, confident that it will get back to their first buy at the 6 low. And once there, they exit. They get out, break even on their first buy, and with a profit on their lower buys. And so the result is you get a test of that price, and then you often get another leg sideways to down. The market often tests entry prices. Here we're testing. Remember I said by the close of R2 it was by the close? Well, look where we went. The 11 low is a test of where it became by the close. Okay, 12 is the end of the first hour, and where did it close? Exactly at the midpoint of the hour. Okay, so exactly half bearish and half bullish, so exactly neutral, increasing the chances that we're in a trading range. Better to sell second reversals down, better to buy second reversals up. Probably sellers around the 6 low. So even though so far a good pair of bull bars, probably back to always in long. After 5 consecutive bear bars, that's enough selling so that we'll probably get a second leg sideways to down. Bulls trying to get back to the 5 close, 6 close. By the close bulls 5, 6, disappointed 7. Never had a chance to get out, break even. Maybe bar 8. That's what I'm saying, 8. It's not clear that it gave the bulls much of a chance to get out. But there are still by the close bulls 5 and 6 hoping to get back there so they can get out. Can this be the start of a big bull trend, a higher low double bottom 1? I think it's unlikely. I think we're in a trading range. Might get a triangle. So might get a couple of small legs up to a lower high and then a couple of small legs down to a higher low. Triangles are common types of trading ranges. Bulls trying to get consecutive bull bars closing near their highs. That will make some bulls willing to buy the close, but I think a trading range is more likely. So I think it's better to buy pullbacks than to buy high. So, and can you sell the close? Well, 12.13 is a surprise, so we should get at least a small second leg up. So I don't want to sell the close when I know we're probably going to get a second leg up. I'd wait for the second leg up before selling. So right now it's always in long by the close, but I think better to wait and buy a pullback. Trading range behavior. Big bull bar 5, they look to sell. 5 consecutive bear bars, they look to buy. They bought the close of 9, they bought more lower. Now we have consecutive bull bars, and traders sold. As I said, a lot of the sellers are the bulls who bought the 6 low and scaled in lower. Now, can you sell below 14, a lower high double top 6? It's a decent pair of bull bars, so it's probably better to wait for a second reversal down, a micro level top. So more likely buyers below 13, buyers below 14. As I said, trading range likely. And it might be a tight range. This might be the high, this might be the low, or it could be a bigger range. The low could be down here, the high could be up there. But in any case, we're probably in the early stages of a trading range. 14, is it buyers below or sellers below? Probably buyers below. It's bearish in trading range, so traders will buy the close, they'll buy the low of the bar, even though it's a bear bar closing near its low, expecting a second leg sideways to up after 12.13. Now, isn't it also a lower high major trend reversal? It might be, but I would still wait for a second sell signal. Remember I said we may be forming a triangle. We may get lower highs and higher lows. Triangles are fairly common. A lot of times they don't look like triangles, but they're still triangles. You know, this is probably a triangle here. This is something of a triangle here. A couple lower highs, a higher low. The shape is not right, but it's still a triangle. An expanding triangle here, maybe. And lots of triangles in here. Big triangle here. You can call it triangle here. Different ways to look at it. 1, 2, 3, 4, 5. Or starting here, triangle. Now, 1, 2, 3, 4, 5. Doesn't look like a triangle, but it's a type of a triangle. Then you get really big ones like this. 1, 2, 3, 4, 5. So the entire day is a triangle. And triangles are areas of agreement. And when you get a breakout, the market usually comes back to around the apex of the triangle. And even though we had a big rally on the open the next day, we came back to the apex of this triangle. For the bulls, 12-13, a resumption of the bull trend from the open. 14 is a high one buy signal bar. It's a fairly big bear bar, so most bears are not going to buy above 14. What happens if we get a second consecutive inside bar, 15, and 15 closes near its high? Okay, well, it's not going to happen, but what I was going to say is if 15 is a bull inside bar, traders would be willing to buy above 15. Now, I said bull surprise 12-13, we would probably get a second leg sideways to up, and 15 is that minimum expectation. So you might get some sellers around the close of 13. Bulls have bought the 13 close, tried to buy more 5 points lower, disappointed at 14. Now they're getting out break even at the 13 close. Also, 14 is a bad high one buy signal bar in what is probably a trading range. So you have limit order bears selling 14 high, selling more 5 points higher. Most traders are better off waiting. It's still on the buy above 11 or 12, not good. And the bears, they have a micro double top, maybe 13, 15, so a sell below 14 low, the neckline of the micro double top. But I think better to wait. Up on 13, down on 14, up on 15, and now we're coming down on 15. So it's a micro double top, and the lowest price in between is the 14 low. So that's the neckline. If I put up a 1 minute chart, you'll see there are the two highs, and the lowest price in between is the neckline. The bears want a breakout below the neckline and a measure move down, and the bulls want a breakout above the double top and a measure move up. Breakout mode. Micro double top, lower high major trend reversal, second leg up after 12-13, but you're right at the moving average and right in the middle of a trading range open. So I think not a very good sell below 14, and obviously not a very good buy above 14. Limit order market. Trading ranges tend to have a lot more limit order trading and a lot less stop order trading. Stop orders and limit orders, think of them as opposites. A stop order, you're buying above a bar, hoping the market will go higher, trend up. So it's a trend trade type of order. You sell with a stop below a bar because you expect the market to go lower. You're expecting a bear trend. And when you're buying above the high of a bar, somebody else is selling. They're betting there'll be more sellers than buyers above, and that instead of a trend, we'll get a reversal. When you're selling below the low of a bar, somebody else is buying, they're betting the breakout will fail, and that will get a reversal. They're betting on a trading range. Stop entry traders are betting on trends. Limit order traders are betting on trading ranges, reversals. And in general, half of all signals are stop order signals, and half of all signals are limit order signals. Half the time, the limit order traders are right, half the time the stop order traders are right. That's just a general guideline. In a strong bull trend like Friday, you can say it's all stop order trading. Well, is it really? No, there were a lot of great limit order trades on Friday. And where were they? Were they selling the high of the bars? No, they were buying the lows of the bars. You buy at the low of every bar, below the 38 low, below the 40 low, below the 48 low, all the way up. So it was limit order traders betting that the reversals down would fail. So there were as many limit order trades Friday as there were stop order trades. There were as many profitable limit order trades as there were profitable stop order trades, almost. So bulls just buying every reversal down. Anything bearish, a bear bar, you buy. A bear bar, you buy the close, buy the market. It goes below the low of a bar, you buy at the low of the prior bar. Here we have a lower high major trend reversal on a micro level top, but a bull body 15. So no one wants to sell below a bull bar when we're always in long at the moving average. So that means there are probably more buyers than sellers 15 low, just like more sellers than buyers 14 high. Looks like we might be forming a triangle. Micro level top, lower high, major trend reversal. Some bears will sell below 14, the neckline. A bear bar closing near its low, but middle of a trading range open. I think the math is not very good to be trading with stops. Better to be waiting for better sell signal bars. If I had to be long or short now, I'd be short below 14. A bear bar closing near its low and a micro double top. But I still think sideways is more likely. So I said I think I would be short if I were in, but I'm not short. So at some point, if it keeps going down, I have to get short. So I'm looking to short, but expecting a reversal. If we get 2 or 3 bear bars closing near their lows, for example, if 17 is a second consecutive bear bar, and it's a pretty big bear bar closing near its low, and the body is completely below the moving average, that would be a reason to go short, sell the close. So we would have consecutive bear bars closing below the moving average, 16, 17, very little overlap between the two bars, and the second bar having a relatively big body and closing near its low, and the body is completely below the moving average. That is a credible sell setup. Sell setup. That's the combination, that entire combination of things that I just said. Consecutive bear bars with relatively big bodies, closing near their lows, closing below the moving average, and the second bar body completely below the moving average. That is a sell to close breakout type of situation. But let's see if the second bar, let's see if 17 is a big bear bar closing near its low. More likely we're in a triangle. A higher low, then lower high, and then a second higher low. So if 17 is a bull bar closing near its high, can you buy that? I said it's not a good buy above 11 or 12 because traders would wait for a second reversal up after 5 bear bars. Well, this is the second reversal up. If the bulls get a good enough looking bull bar 17, it'll be a buy setup. And for the bears, they need more than a bear bar. They need a bear bar closing near its low and having a pretty good sized body to attract sellers. So the question is going to be, is 17 going to be a big enough bull bar closing near enough its high for bulls to take a chance that we're going to get a breakout above the triangle and get back above yesterday's high? The more bullish 17 is, the more bulls will take the buy. The less clear it is, the more bulls will wait. what the bulls want, not what the bears want. Better to wait. We have consecutive bars closing below the moving average, and one is big, and the second one does not have a bull body. So some bears will sell the close. And then for the bulls, it's a triangle, and it's 2 legs down, 14, 16. And some bears will buy above 17, but I think most traders should wait. For at the moment, it's slightly more bearish than bullish. Lower high, major trend reversal, and consecutive closes below the moving average. But the best choice is wait. It would be better if the bears had a better sell signal bar, 15. You can sense the hesitation, right? It looks bearish for a bar or two, and it looks bullish for a bar or two. The market's still deciding on the direction of the breakout. 3 legs down, 14, 16, 18. Higher high double bottom, 11. A triangle. We've got 5 legs. 1, 2, 3, 4, 5. Bulls need a good bull bar, otherwise they'll wait for a strong upside breakout. When you're in a breakout mode pattern, a triangle is an example, 50% chance the first breakout up or down will fail and reverse. And 50% chance it'll ultimately be a successful bull breakout, 50% chance a successful bear breakout. Better to wait for either a good-looking buy or sell signal bar or for the breakout. You can see right in the final second how that went from a doji bar into a bear bar. It's also bar 18, a multiple of 3, so it corresponds to the close of a 15-minute bar. And the 15-minute bar suddenly closed near the low of the bar in the final seconds. For the bears, a lower high double top or a low 2, but a bad sell signal bar, 15-minute chart. And 5-minute chart, always in short, but only for swing traders. The probability is not high yet. The bulls are going to try to get some kind of a double bottom 11. So what are the bears doing if they sold the 17 close, the 18 close? A lot of them are disappointed that we're reversing up and they have not even been able to make a 5-point scalp. So they're buying back their shorts. And the bulls are trying to get a lower low double bottom 11. So they bought the 11 low, betting that a lot of bulls would be buying around the 11 low. To buy above 19, it's a 4-bar bear microchannel, 3 bars without a bull body. The bulls will want as good a bull bar as they can get. So they'll want 19 to be a bull bar closing there as high, but they don't want it to get too big, which it's doing right now. They don't want to buy too high up in their trading range, and they don't want to buy right at or just below the moving average. So again, trading range behavior. The market is doing things that kind of look like what either the bulls or bears will want. And then you look at it and say, oh, but there's still something wrong with it. Trading ranges, there's something wrong with everything. Bar 5, you think it's going to keep going up. Bar 9, 11, you think it's going down. You know, bad signal bars, 6, 11. Limited follow through, just 2 bull bars, 12, 13. No consecutive big bear bars at all today. The bulls have had a couple pairs of consecutive decent bull bars, 1, 2, and 12, 13. So outside up 19, you buy above 19, you're buying right in the middle of a trading range open at the moving average and above a bear bar 18. So it's probably better to wait for a second bull bar 20. If 19 closes at or above the moving average and 20 is completely, and the body of 20 is completely above the moving average, it would be a buy the close and a good attempt at a breakout. But that's probably not what's going to happen because we're in a trading range open and nothing happens the way trend traders want. Everything is disappointing. Most traders are better off waiting possible buy 19 if it closes near its high and at or above the 18 high. But you're in the middle of the trading range open and just below the moving average. So it's probably better to wait to see what 20 looks like before buying. Bars often change their appearance in the final second or two, like 18, it was a doji bar and became a bear bar. And 19, the bulls want 19 to close at or above the 18 high. Will it happen in the final second? Nope. So better to wait. I know it's not particularly bullish or bearish at the moment. The bulls hope double bottom 11, start of a bull trend. The bears are hoping 15, lower high major trend reversal, and that they're hoping 20 is another lower high, and that we've begun a series of lower highs, and that it'll end up as a bear trend. The bears want good-looking sell signal bars, so they'll want 20 to close on or near its low. It's already bigger than what most bears want, so that will reduce the number of bears selling below 20, and that tail will also reduce the number of bears selling below 20. These PowerPoints that I keep bringing up are from my encyclopedia of chart patterns. Sometimes a day begins and it looks fairly neutral, but if you start to notice, hey, a lower low, another lower low, a lower high, another lower high, at some point everyone decides we're in a bear trend. They want to see consecutive bear bars. They want to see consecutive bear bars closing below the moving average. They want to see consecutive bear bars closing below the moving average and near the low of the bar, and they want to see a bear body completely below the moving average. So the more of that they get, the more they conclude we're in a bear trend, and they'll start to sell closes, and then they'll sell rallies up to the moving average for the rest of the day. The bears are hoping we're at this point right now, but right now we're not doing what we did here. A decent sell signal bar here, a decent sell signal bar here, 3 bear bodies closing near their lows, and we're not getting that kind of bearishness yet. And that makes it unlikely we're going to do that. But I'm pointing that up as an example of how we have to pay attention to lower highs, even if they don't look all that good. Bear channels sometimes begin with lower highs that don't look like lower highs at all. Here we have a double top, and then look at this high, it's below that high. Look at this high, it's below that high. Look at this high, it's below that high. At some point, you have to say, wait a minute, it's a trading range, but we keep getting lower highs, and we're now getting lower lows. This might be the start of a bear trend. And everybody starts to conclude bear trend in here, and then especially here. Another example, lower high, still in the trading range, but we're getting lower highs. More and more traders start to conclude that it's an early bear trend. I did not sell below 20, but if it closed near its low, I would have sold below it. So right now, I'm waiting for more evidence. The bulls need a good buy signal bar. Then we have a wedge 16, 19, and a high 2, 11. 21 is not a good buy signal bar, but it's also not what the bears want. Consecutive bear bars 20, 21, but not consecutive big bear bars closing on their lows and below the moving average. So slightly more bearish than bullish, but really not sell the close. What about selling the 21 high? It's not a very good buy. If I had to choose between buying and selling the 21 high, I would sell. It's a bad buy signal bar right below the moving average, but I think most traders, they're better off waiting for things to become more clear. 2-bar reversal, wedge bull flag 16, 19, high 2, 11, but a 2-bar reversal closing below the moving average. Most traders are better off waiting. This absence of good buy or sell signal bars is a sign of a lack of conviction. traders unable to create convincing bars, and it's because they're not strong enough. And that's been the case all day long. You know, selling below 2, buying above 3, selling below 6, buying above 11, selling below 15, buying above 18, selling below 20, buying above 21. Much more limit order trading. Traders selling at the tops of buy signal bars and scaling in higher, or simply scaling in 5 or 10 points higher, and buying at the bottom of weak sell signal bars like 6 or 15, and scaling in lower, or just buying 5 or 10 points below and looking for 5-point scalps. If we're going to get a trend, and we will, it's probably going to last for a couple hours. It's possible 6 is the start of a trend down. It's possible 21 is the start of a trend up. If we're going to trend up for a couple of hours, that's 20, 24 bars. There'll be other opportunities to buy that have higher probability than here. So I would wait for maybe a couple closes above the moving average, a couple of bull bars, a couple of consecutive bull bars closing on their highs and above the moving average, and the second bull bar having a body completely above the moving average. If we get that, then I think it's probably worth buying closes and taking the chance that this is the start of a trend up that could last a couple of hours. If we do not get that, I would wait. For the bears, if they were short, I'd get out above a bull bar closing near its high, 22. Getting near the end of the second hour, and what did I say an hour ago? I said we had 9 consecutive bull bars, and that's a lot. And when you have a streak like that, the market tends to go sideways. Here we have a streak like that and sideways. I didn't talk about just how much of a streak you can get, but I have some examples. One of the useful things for me with this encyclopedia is every day I classify everything that happens, and I put it in an appropriate section. And then if I see that thing happening again, I can look at that section and get an idea of what to expect, and also get an idea of how likely the thing is going to happen. Okay, so here's a streak on a higher time frame, a monthly chart, 15 consecutive bull bars, really unusual. It was the longest streak in the entire history of the stock market, and this is what happened, sideways for a couple of years. Let me scroll down to the 60-minute chart. Here's the daily chart, 60-minute chart. Every bar above the moving average for 67 bars. Really unusual. And when something is unusual, it's probably not going to become much more unusual. Therefore, it's unsustainable, and it'll stop doing what it's doing, and usually you end up going sideways. 70 bars without touching the moving average. Okay, really unusual. 60-minute chart, 11 consecutive bull bars and then sideways. 60-minute chart, 12 bull bars, sideways and then down. 11 consecutive bull bars here and sideways. And remember, right now we have 9, and if 24 closes above the open of 13, this will be 10 consecutive bull bars. So this hour opened with bar 13 here. And if 24, the current bar, closes above that red line, then we'll have 10 consecutive bull bars. And remember, I have streaks of 11 consecutive bull bars, 12 consecutive bull bars, And how many streaks of 13 consecutive bull bars do I have saved up? 0. So how common is 13 consecutive bull bars? Really uncommon. I'm sure it's happened, and I probably missed it, but it happens very rarely. We're right now at the outer limits of what traders can expect. And how does a streak of bull bars end? With a bear bar. So, is 24 going to close above the red line and create a 10th consecutive bull bar? If so, what are the chances we'll get 11? It's rare. I only have 3 examples of 11 consecutive bull bars in the past 10 years. There may have been more, but I've only recorded 3. In any case, it's rare. So we're going to get a bear bar today, and it will probably be here, bar 24 or bar 36. And that means that even if we're always in long here, we're probably not going to go up all that far, because the next hour is going to have a bear body. The next hour is going to close below the open of the hour. The hour opens with bar 25, so bar 36 will probably close below the open of bar 25. And that means if we go up, we'll probably come back down before the end of the hour. Still 3 minutes left. And we could still close below the red line and get a bear bar on the 60-minute chart, and that would end the streak at 9 bull bars. Now, are the computers, did the programmers think about what I'm talking about, the streak of bull bars? I'm sure there are a lot of computers out there that have algorithms based on streaks, all kinds of streaks. Consecutive bull bars is one of them, all kinds of time frames. So there are computers that are trading based upon a streak on the 60-minute chart. Half a minute left. Is this hour going to be a bear bar? If not, then probably the next hour will be a bear bar. I do not have a streak of 13 consecutive bear bars. We came into the day with 8 consecutive bear bars. So the odds of having 5 consecutive bull bars today is very small. That means we should get a bear bar today. Okay, here's the end of the hour. It closed above the open of the hour, and therefore we have another bull bar on the 60-minute chart. There are 7 bars to the day, so we had 7 there, 2 today, and then 1 on Thursday. So that's 10 consecutive bull bars. And that's at the outer limits of what you typically see on the 60-minute chart. And therefore, we're probably not going to go up for another hour. If we go up, we'll probably reverse before the end of the hour, and we'll probably close below the low of the hour, below the open of the hour. The open of the hour is right here, the open of 25. The bears are hoping that, yeah, we went above 20, but we did not get above 15, so they're hoping it's still a lower high. But with 3 bull bars, 2 closing above the moving average, traders are not going to be eager to sell below 25. So you get bulls who bought above 22, and what do? Well, it's a small trading range day, and in trading range days, traders tend to scalp. So a lot of the bulls who bought above 22 are looking to scalp. Scalps there are about 5 points. So that's 20 ticks. It has to go 22 ticks above 22 for them to make their scalp. And that's exactly what it did. So far we're 22 ticks above 22. That's exactly where the 5-point scalpers will take profits. Bulls are hoping that we go a lot higher. They're hoping that these 4 bull bars will be the start of a bull trend that will last all day, or at least a couple hours. But we know it's probably not going to last a couple hours. It's probably not going to last 1 hour, because we now have 10 consecutive bull bars on the 60-minute chart, and we've only had 3 instances of 11 consecutive bull bars that I can remember in the past, in the past what, 5 years, 10 years? So a streak of more than 10 is unusual. I only have 3 examples. There's 11, there's 12, 12, 11, 11. That does not mean we're going to get a bear trend. It simply means we get a bear bar. So the streak ended with the bear bar here. We still went higher, but we got a bear bar. Is it by the close yet? Well, we got consecutive bull bars closing above the moving average and one body completely above the moving average, 24. So you'll get more bulls willing to buy the close. But 23, 24, 23 did not close on its high, and 23, 24 are not especially big, and we did not yet break above 15. So you still have other traders waiting for things to become a little bit more clearly bullish, afraid that this could be a wedge, 20, 23, and a double top, 15. The bears, if they get a really good bear bar, 25, they'll sell. But after 3 bull bars, 2 closing near their highs and 2 closing above the moving average, they will want to see a very good bear bar, 25, to take the short. For the bears, a double top, lower high, major trend reversal. So a lower high major trend reversal, where the lower high is a double top. Bull trend, bear breakout, and we have a lower high, but it's a double top lower high. So it's a lower high double top major trend reversal. And a lot of times it starts out, it doesn't look like the start of a trend, but it ends up as the start of a trend. We have a double top lower high, and it led to a major reversal down into a bear trend. Second leg up of a double top. About a third of the time, the second leg up is a buy climax. It's still better to wait for a bear bar closing near its low before you short. We have a lower high and then a double top with that lower high, and then we got a reversal down. This is what I'm wondering about on the daily chart, that we may get near the all-time high, but form a double top just below the all-time high. Daily chart. So we may get up here and form a double top here and then reverse down instead of making it all the way up to the all-time high, the January high. Buy the close. This is one of those times when if you buy, it's better to buy small. And if it goes higher, then you can buy more as it goes up. Testing the Globex high again. Testing the 15 high. The bears want a double top and a good sell signal bar, 26. And the bulls are hoping we break strongly above 15 and then break strongly above the high of the day. Now remember on the open, what did I say? I said 75% chance we'd have at least a couple hours of sideways to down trading that began before bar 24. And that's what we've had. We've been sideways now for a couple of hours. The bulls are trying to resume the bull trend, but the bears have their minimum objective, a couple hours of sideways trading. So they no longer have that objective. That objective has been met. Now traders look at other things. Are we going to resume the bull trend? Are we going to break strongly above 15? Are we going to reverse down and get a double top with 15? Buy the close, trade small, and look to buy more higher. And I would get out 1 tick below a bear bar. I would get out maybe 2 or 3 points below a bull bar, any bar. And if the bears get a good sell signal bar, 26, it would be a short, and I definitely would get out of longs. More bulls buying, betting we're going up to the next resistance level. Yesterday's high of the day. Bears, we now have 5 bull bars. Bears are not going to sell the first reversal down 26. They'll wait for a micro double top, like 13, 15. Testing yesterday's close again. but not a very good double top. 15 is resistance, and we've gone a few points above it. So it's not acting like resistance, and most traders are not going to sell below 26. It's buy the close right now, but trade small. We still might be in a trading range, and there still might be sellers around the high of the day. Breakout, high of the day, 6 consecutive bull bars. The bull bodies are getting bigger. Traders will buy the first reversal down. Sometimes a big bull bar, 27, will attract some profit takers. But right now it's buy the close, buy for any reason, and buy the first pullback. Again, if you're trading on trade small and look to add on if it goes up, and if it pulls back and then you get a high one, you could add on there as well. Can we reverse straight down a buy climax, a high 2.6, a wedge 78.6? Probably not. The bears will probably need at least a micro double top. Can this continue up as a strong bull trend? We're getting really close to what I think are really important magnets. And 20 points is certainly within reach. The day's range would only be about 45 points, and that's not especially big. So we might get to that triple top on the daily chart. Over here, daily chart, we got this triple top. And I think, I've been saying, I think we're going to get above it. Can we reach the bear trend line without pulling back? I think we're going to reach the bear trend line, but we might pull back first because we're already very extended since the July low. So I think we'll get a pullback before we get to that trend line. That trend line right now looks like it's around 43.60. But this is only another 15 points above. So I think we'll get there. It looks like we're going to get there today. The bears will try to get a double top there. The buy the close bulls who bought there, disappointed by all of this, a lot of them will look to sell once it gets back here. So this is a magnet and resistance, and we probably will pull back somewhere around this triple top. Party's getting bigger, 24, 25, 26, 27, 28. So it's becoming parabolic, and that can attract profit takers before we get to the target. If we go up for a measured move, we're in a trading range here, so breakout move. And so traders are looking for a measured move up or a measured move down. And measured move up gets us about there. Sometimes the measured move will be based upon the entire opening range from the one low. That would get us above that. But right now, my first measured move target would be there. If we get a little bit above it, then I would look for a measured move based upon the entire opening range. And that's up there. Still buy for any reason, but trade small. You're buying in a buy climax, so you can get a sharp reversal. However, traders will buy the first reversal down. This is a very strong breakout. It's still likely that we'll enter another trading range, and it could last the remainder of the day. You know, it's possible that we just go all the way straight up here. And even if we do, we'll probably enter a trading range there. So I do think we're going to get a lot more trading range trading today. The bears will probably need a micro double top, and a lot of the profit takers will wait for a micro double top. And that's why traders are willing to buy here at the top of a buy climax. They know one of two things is going to happen. Either it keeps going up and they can make money, or it'll go down, they can buy more, expecting it to get back up and test the high, and they can then get out break even on their first buy with a profit on their lower buy. Smaller body and tail, so a little bit of profit taking, but still buy the market, probably buyers below. I would not sell. I'd wait for at least a micro double top before selling. Bulls will buy the first reversal down. might get a trending trading range day, a common thing. Trending trading range day. You get a trading range, a breakout. It can be very strong, but usually brief. You often get a second or third leg up and then a trading range. So I think this is probably what's going to happen. Strong breakout like today, second leg up, third leg up, but mostly a trading range in here. So I think that is what we'll get. Now I talked about the streak of consecutive bull bars on the 60-minute chart, and I said that I thought these third hour today would have a bear body, and right now that is unlikely. And this is going to therefore be the 11th consecutive bull bar. And I only have one example of a 12th consecutive bull bar on the 60-minute chart. And therefore, we'll probably get a bear bar on the next hour or the hour after that. That, as I said, that does not mean a trend reversal. It just means a pause. Here we have 10 consecutive bull bars and then a bear bar. Here we pull back a little bit. Here, 11 consecutive bull bars and then a bear bar. Here we have 12 consecutive bull bars and then a bear bar. It turned out this led to a trend down, but it's more likely to simply lead to a pause in the bull trend. A pause in the bull trend. Bear bar, but 8 consecutive bull bars. So on the 5-minute chart, we have a streak of 8 consecutive bull bars. 60-minute chart, we currently have a streak of 11 if you count the current hour. But just like the 5-minute chart finally has a bear bar, the 60-minute chart will probably get a bear bar. I don't think they'll get it this hour, but the next hour probably will be a bear bar, which means that the next hour probably will be sideways. Now, this is, you can argue, a wedge, 78, 6, and a buy climax, but with 8 consecutive bull bars, probably more buyers than sellers below 30. The bulls, they can get out 5 points below 30, 3 points below 30. If we get 2 bear bars and the second one closes near its low, the bulls can get out below that. But probably buyers 30 low, buyers 5 points lower, 10 points lower. Too early to short. The bears, I think, should wait for a micro double top. Or if we start to get a series of bear bars like here, at some point, if you get 2, 3, 4 bear bars, you'll start to get bears shorting. However, there should be buyers 30 low, maybe the 6 high. That was resistance. We had a double top and turned down. We broke above it. So it's probably now support. So reasonable to either get out below 30 or 31, probably buyers below 30, and probably buy the close 31 and scale in lower. The bulls would like to get a high one with a good buy signal bar, maybe 31 or 32. But smart bulls know that we're probably going to enter a trading range. You know, we could get 2 or 3 legs up before we clearly enter a range, but this is probably the early stage of trading range. So I do think we're going to go higher, maybe up to 4,300, maybe up to the measured move and that high. But I think we're going to be in a trading range. When we look back several hours from now, 30 will be in a trading range. It could be the top of the range. It could be the bottom of the range. We could go up a little higher and then form a trading range up here. But this is probably the early stages of a trading range. Like this. You know, here it went quite a bit higher. Here it went a little bit higher and then trading range. Bears are hoping that we're just immediately putting in the top of the range and then we just go sideways to down. Here, another example where it went up strongly, and that was the end of it. It just went sideways for the remainder of the day. That became the top. More likely, this is not going to be the final high of the day. Bulls want a high one with a good buy signal bar. And for the bears, most bears want at least micro double top. it's unlikely the bears will get a swing down for at least an hour or two. The breakout is so strong, the market probably will have to be in a trading range for at least 10 bars before the bears have a reasonable chance of a trend reversal. So this is a minor reversal, not a trend reversal from a bull trend into a bear trend. It's a minor reversal, a bull trend into a bull flag or a trading range, and then a second leg up. The more bullish 31 is, the more bulls will buy on a stop above 31. If it's less bullish, they'll wait for maybe a high 2 or a wedge bull flag or a test of the breakout point, the 6 high. Probably not a lot left to the rally, but there are magnets 15 points above, and we might get there today. The easy money, the buy the close money, 25, 26, 27, I think that is over. So now I think it's going to be more scalpers buying for scalps, taking quick profits, 5 points, and less swing trading. The swing traders bought, 24, 25, 26, and maybe 27. And I think the traders buying this late are more scalpers, scalpers who are willing to buy more lower, and they'll scalp for 5 points or 10 points. Now, if you're a buy the close bull and you're disappointed 30 and you get out below 30, and you're trading always in, you wait for a bull bar closing near its high, like 31, and you can buy again, or you can buy on a stop at a new high above 30. Traders don't know if we're going to go a lot higher or if this is the start of the trading range. If you're buying here, the trick is your stop. Do you get out below 31? No, you probably need a wide stop down here. So if you're buying up here, I think it's better to trade small. Remember, you have two position sizes. The small size is 20% of your normal size. So if you normally trade one E-mini, you could buy 2 micro E-minis on a stop above 31 and use a wide stop, buy more 5 points lower, 10 points lower, and then get out, way down here somewhere. Just allow for a really deep pullback. And for the bears, they'll need at least a micro double top, and even then, it's unlikely we're going to go down very much in the next several bars. More likely, the best the bears can get is sideways, so 4 or 5 bars, minor reversal. Can we get a midday reversal today around bar 40, 41, and go from a bull trend into a bear trend? It's always possible, but with this much relentless buying, I think it's unlikely that if we get a midday reversal, we'll get a new low. Chances are, if we get a midday reversal, it'll lead to an upper trading range and a trending trading range day. So trading range, breakout, trading range. So chances are we're not going to come back down here at all today. But I think this is not going to be the final high. I think we'll go higher, maybe 1 or 2 small legs up. We might pull back more first, but I think we'll go at least a little bit above 30, maybe up to 4,300, maybe up to that triple top over here, April 28th high, the measured move. And on the downside, probably buyers around the 6 high and the moving average. Remember back at bar 31, I said the market was probably entering a trading range, and 31 could be the bottom of the range, it could be the middle of the range. And right now it's the bottom of the range. Tight trading range through here. When the market looks like this, it's usually better to do nothing. Sometimes I would take the short. We have a double top with 48 and 59, but it's a really tight range, and the downside is not very good. I say that because Friday's rally was so exceptionally strong, and it was a reversal up from a sell-off on Thursday, that chances are we're going to get follow through buying today, which we have, or for several days. Now, I've been saying that I thought either bar 48 would lead, saying that either the last hour or the hour before was going to have a bear body. And I drew this line in here. This is bar 49, the open of the 5th hour. And bar 60 is the close of the fifth hour. And what do you notice? Can you see that the close of bar 60 is below the open of 49? I thought that either the fourth hour or the fifth hour would have a bare body. And this has a small bare body on the 60-minute chart. We're just below that red line where the hour opened. And that ends the streak. And the streak ended with, 12 bars. We had 7 bars Friday, 1 bar Thursday, that's 8. And then we had 4 bull bars today, that's 12. And I mentioned that I collect streaks and I put them in the encyclopedia. And I said that I don't ever remember seeing a streak on the 60-minute chart that had 13 consecutive bull bars. I'm sure it has happened, and I missed it, but it has not happened very often, because if it has happened a few times, chances are I would have observed at least one of them, and I would have saved it, because I save all the chart patterns that I can find and put them in the encyclopedia. And for streaks on the 60-minute chart, here are the 3, 10 consecutive bare daily, that's the daily chart, 60-minute chart. That's bare, so I want the bull streaks. Okay, here, go to bull streaks. Okay, 60-minute chart, a lot of bars above the moving average, that's a streak. And then here, we have 12 consecutive bull bars through here, this brown box. And then we had a bear bar, and we ended up getting a reversal. Here is a streak of 11 bars, and we finally got a bear bar, and we only went sideways. We did not go down. Here's another streak of 11 bear bars, and then like today, it's only a bear doji. And here we pulled back a little bit and sideways for a couple of days. I think we'll probably be sideways for a day or two. I think we have to go higher. I think we have to get above that April 28th high. It's a triple top on the daily chart. And you can see on the daily chart, we're almost there. Here's that triple top. I talked about that at the time, that it was really unusual. So it would function like a ledge. And I said, even if we sell off, we'll have to come back and test it. And that's what we're doing today. Testing it, we probably have to go above it. The highest of the 3 bars is this one. And that's where the blue line is. Actually, no, let me make sure the blue line is right there at the highest of the 3 bars. Okay, so we'll probably go above it. I don't know if we go all the way up here or here. The next significant target is the start of this cell climax, and then here. I don't think we're going to go straight up to a new all-time high before we test down, and I think 4,000, the big round number of 4,000, is a reasonable target. It was such an important price for the past couple of years that I think we're breaking above it. I think we'll have to come down and test it. Here, I don't think we're going to get a big move in either direction. The reason I don't think we'll have a big move down is yesterday's trend was so strong, Friday's trend, and then today was strong. Usually when you have that kind of strength, you do not get a big reversal. Sometimes you'll get a climactic reversal and a big sell-off, but more often you're not going to get a big reversal. So the chance of this becoming a big bear trend today is small. And for the bulls, we're right at the next important target, and there's not a reachable target above that. If I put up a 60-minute chart, target above that. If I put up a 60-minute chart, okay. So the next target above that is way back here, and that's a couple hundred points, 300 points above. So I don't think we're going to go that far up. Let me slide this over. Let me slide this over. Let me put up a 4-hour chart, make sure I'm not missing anything. Okay, 628 high, yes. 726 low, let me make that blue. Then I go back to a 60-minute chart. Okay. That's all good. Let me go back to a 5-minute chart. And bulls are hoping this continues up in a small pullback bull trend to the target above. I almost reached this measured move. I talked about how we've tried to get, we have a wedge bull flag, a wedge channel, and breakout mode. So I thought we'd go up for a measured move. I said the breakout measured move could be based upon the entire opening range from the one low, but this was an area of agreement, down, down, down. And so it's an obvious support level, an obvious resistance level, and that's why I said let's look at a measured move here. Did not quite get there here. I suspect we're going higher. Right now, I think we're going higher, despite having the bear bar on the 60-minute chart. The bear bar on the 60-minute chart, it's only a doji, not a strong bear bar. I'm going to switch and do it over here, 60-minute chart. So for the bulls, it's a high one, but not a great looking high one. It's, we have 12 consecutive bull bars, good for the bulls, but then we have a bear doji and a buy climax, so not good for the bulls. So I don't know. To me, that does not look like a strong 60-minute buy. We may go up here somewhere and get a wedge, 1, 2, 3, but we also may simply go sideways. A doji bar, a tail, and an extreme buy climax, 12 consecutive bull bars. Back to the 5-minute chart. So we're on a double bottom bull flag buy 57, a high 160, and no credible top. The bears are trying to get a double top. If they get another bar that looks like 55 or 59, that would be a reasonable sell. A wedge rally to a double top. That's a common reversal pattern. But as I said, I think with the buying so strong Friday and so strong today, I think the market is going to tend to go higher. So I think if we reverse, we'll probably stay in the trading range, maybe test the 51 low, maybe the 31 low. I doubt we're going to come back down here. So not good buy the close here. It's more stop order buying above 51 if you use a wide stop, above 57. 57, you can use a tighter stop. You have a credible double bottom. You could argue wedge 46.50. So if you buy above 57, you can stop below 57. And now we have a higher low with a decent buy signal bar of 60. So the bulls could exit below 60. The difficulty here is we're at the top of a trading range. That lowers the probability for the bulls. And the profit potential is not great. We've been in a trading range now for half the day since bar 30. And the magnet is about 5 points above. And if we do go up, I think we'll have a hard time getting much more than 5 points. And on the 60-minute chart, the buy climax is so extreme that we're probably soon going to go sideways. And we may have started the sideways a couple hours ago. So that further reduces the chances that we're going to go up big this hour. So, I think this is probably what the next few hours will look like. Run into tomorrow. It's possible we start to go sideways up a little more and then more sideways. But I think over the next couple of days, we're probably not going to go much higher. Okay, I'll put the 4-hour chart. Well, I'll get rid of that one. There's a breakout point here. I think 4,000 is more important. Back to a 60-minute chart. I'll get rid of this for the time being. This is not strong by the close. We're at the top of a trading range. And I don't think, if we do reach the blue line above that triple top, I don't think we're going to go much above it today. So I don't think either. I think 44 will be the high of the day, or maybe we'll go 5 points above that, but I don't think we'll go 10 or 20 points above that. And below, we may get down to the bottom of the range, 51 or 31, but I don't think we'll get much below that. So I think we're basically going to stay sideways, maybe a little bit higher, maybe down to this area, but probably mostly sideways. Double tops, you often get a wedge rally to a double top. And we have a little wedge here. 1, 2, 3, and we have a double top. And as I said, if we get another bear bar closing near its low, 63, like 55 and 59, it's a reasonable short. Bears hope that we get a collapse like 9. They know we probably will not. The bodies are getting smaller. We go sideways for many bars at a time. We're probably not going to go far. So probably not a lot of profit potential up or down, unless the bars get bigger and they stop overlapping one another. When you see this, the open of the bars at the close, and there's a very small tail below, not much overlap between adjacent bars. When you see that, not much overlap, that means traders believe the market has to go higher. They're buying at the market, and they're buying small pullbacks, 1-point pullbacks, 2-point pullbacks, 3-point pullbacks. They're not looking to buy big pullbacks, and they're not expecting the bears to make money even with limit orders. So that means they're not expecting 5-point pullbacks. But when you get a lot of bars that go sideways, several bars at a time, that means traders think the price is just about right. And that reduces the chances of the market going a lot higher or a lot lower. Very common for the market to rally for half the day and then sideways for the remainder of the day. And the sideways usually begins before the rally ends. The rally ended at 44, but I said the trading range began at 30. If you want, you can say the trading range began at 44, but the trading range bars began with the tail here and the doji here. A doji in a strong trend often is the start of a trading range. And we got 30, 31, 34, 35. We started to get several dojis. So that was telling us that traders are trying to trade in both directions, and they're losing conviction. They don't think we're going to move much from that area. Okay, outside down, but tail and close above the 62 low, and small pullback bull trend. So yeah, you might get out of longs below a bear bar, closing below its midpoint, 63. But I think it's not a very good short. Can you buy the market? Buy at the moving average. It's probably better to be buying high ones with stops like 60. Well, you can see there's just not much profit potential. 60 and only up 3 points, so you could not even scalp for 5 points. When the bars get smaller like this, it becomes difficult to scalp for 5 points and impossible to scalp for 10 points. So you have to decide, do you scalp for a smaller amount, 2 points, 3 points, or do you wait? And most traders should either wait or swing trade. You just take a buy above 60, above 51, above 57, and run your stop up and hold, hoping that the small pullback bull trend goes up 10 or 20 points, knowing that it probably will not. You can see outside down, but they bought below its low. 62, bull bar closing near its high, they sold above. So limit order type of trading. Still small pullback bull trend, still always in long, still okay to be long. I would not short yet. 63, if it closed on its low, at or below 62, I might have shorted it, but it did not. So I think it's still better I think best choice here is flat. Second best choice is long. Right now, stop below 60, and once 64 closes, then stop below 64, and hope that we not only reach the measured move and that triple top high on the daily chart. The bulls are hoping we break far above it. So another high one. But for most traders, I think it's better just to wait. It's a weak rally, 51, at the top of a trading range. So chances are we're not going to get a strong breakout above. Bulls who do buy above 64, small pullback bull trend, I'd get out below 64. I'm currently flat. And you can see why the 63 high is exactly right there, right? The bulls who bought above 57, disappointed at 59, decided to try to scalp for 5 points, and 63 went up just far enough for them to exit with 5 points. So part of the selling 63 is high one bulls 57, disappointed 59 and 63, or disappointed 59. Top of a trading range, a lot of limit order trading. You can see there might have been more sellers at the 64 high than buyers. Most traders should not be trading this. You know, you can see it's hard even to make 5 points. You have a decent high 160, and the bulls could only make 2 or 3 points. Can 65 close near its low? A second reversal down like 45. If it does, you'll get some traders selling a double top major trend reversal, lower high major trend reversal. Okay, it's a bull doji, so not a good sell. And for the bulls, it's still a small pullback bull trend since 57. Well, a lot of quiet trading for 30 bars now, 35 bars, and we're at the top of it. So not very good math. The traders who are buying are hoping for a repeat of 26, 27, 28. They know they're probably not going to get it, but they're hoping that we'll get a smaller version of it. You know, so instead of going up 20 points above 24, they're hoping we go up 10 points and get well above the triple top. You get up here. Bulls trying to break above 4,300, big round number, psychological resistance. High of the day is always resistance. We have this measured move, but the most important price is that one. That's the top, the highest of the 3 highs on the daily chart. We had 3 highs right around the same price. Still an attempt at a wedge rally and a lower high major trend reversal. Now the wedge is 58 and 63, but it's a small pullback bull trend, and the bear bars are not particularly good. And we have a really important magnet above, so I think I don't want to sell below 66. And for the bulls, well, for bulls or bears, there's probably not much profit potential. You know, the bars are just really small. Trading range near the top, I prefer to look to sell, but I want a decent sell signal bar. 1 tick breakout above the high today. So the bears are trying to get a higher high double top, and the bulls are trying to reach, they're trying to break above that April 28th high. And as I said, I think they'll do it. I'm not sure they'll do it today, but I think they'll do it soon. You know, probably this week, maybe tomorrow. And I think there'll be bulls selling there. Here's the daily chart. Okay. Expanding triangle bottom. Pretty good rally here, pretty good rally here. And then, you know, 3 attempts up, unable to go up. The market went the other way. And some bulls who bought that close held long and bought more lower. And it went further down than they want. So they're looking to sell out of their longs around where they first bought here. They'll get out break even here, and then with a profit on their lower longs. So there's supply here. There are bulls looking to sell right around where we are. You can see we're right at that triple top. So that's why I think we'll probably pause, maybe go a little bit above it, and then pause. Still small pullback bull trend, but not a lot of bulls willing to buy. The past 6 bars, 7 bars, we're still within a 4 or 5 point range. And the bears selling when the channel is tight, the bears don't like to sell unless they have a perfect sell signal bar. The context is good, a higher high double top major trend reversal, and a wedge 58.62, but selling with stops and a small pullback bull trend is a low probability way to trade. We had a small pullback bear trend here, and traders who sold, I don't even think they made 5 points. By the way, I did sell. I placed a limit order. The hour opened at bar 37, and I thought the hour would try to close below 37. So I sold with a limit order 5 points above the 37 open, thinking that we would test below the 37 open, which we did. When you feel like you're waiting for more information, you're probably in a trading range. Things are not clear. Well, one thing is clear. The market's probably not going to go very far in either direction. So, really, not good trading. Most traders should just wait. We have lots of clusters of 3 or 4 or 5 sideways bars. The bodies are small. The tails are relatively big. That's a sign of a market that is at a fair price. And, it lowers the chance that we're suddenly going to get a breakout. For the bears, outside down, a wedge, a higher high double top, but 3 dojis, I think not a good sell. And for the bulls who bought above 64, right now their stop is below 64. You get out below 67 or below 64. To me, I'd get out around break even. If I bought 64, which I did not, and then I saw 65, 66, and then a bear bar 67, I'd place a limit order to get out around break even. And that's why the high of 68 is exactly where it is. There were a lot of bulls giving up. And for the bears, I think it's just not strong enough to sell. Bulls, they can keep a stop below 64 or below 57, but I just don't think the market right now is doing enough to make me think the profit potential is very good. I'd rather wait to see it start to break out like 24, 25, 26, and then buy, or if it goes the opposite way, then sell. Hard to hold long, right? And for the bears, so far, it's not a strong sell. 1 tick higher high, 67.44, but it's still a small pullback bull trend. We're right above the moving average, and 67 is a weak sell signal bar, outside down by the doji. Bears, they'd like to get consecutive bear bars closing below the moving average, not just one like 50, 56. They want consecutive bear bars closing below the moving average, and they want not much overlap between the bars. They want big bear bodies, and they want the second body completely below the moving average. So the bears have several things to do before traders will believe that this is the start of a trend reversal. And therefore, at the moment, it's not likely that this is the start of a trend reversal. More likely, it's a continuation of the trading range that began at bar 30. Limit order bulls buying the moving average. Other bulls have limit orders to buy 5 points down, 10 points down. And then stop order bulls are hoping for another bar like 60. Well, it has the same problem of 60, pretty high up in a trading range. the bulls taking the buy are hoping we get one more strong breakout, like 26, 27. They're looking for a breakout above this. But even if we do get the new high, it probably will only go a couple bars above 67 before we reverse again for a possible wedge 44, 67, and then maybe 70, 71. Probably not going to go very far for the remainder of the day. So is it worth buying above 69? I'm not. Also, the bar is getting big, and that creates two more problems. One is your stop is further below if you buy above 69 and you put a stop below 69, and you're also buying closer to the top of the range, which lowers the probability. Now, I think I talk about this all the time, that the single most important thing that a trader can do to convert from losing money to consistently making money is stop taking bad trades, and just patiently wait for better trades. And the better trades tend to happen fast because not just you see the trade as better, everybody sees it as better. 26, 27, 28, everybody sees it's going up, so everybody buys. And trades like this, when you're sideways for 8 bars, 10 bars, buying with the stop above, selling with the stop below, you just lose money. You sell below 63, buy above 64, sell below 68, right? And you lose 3 points, 5 points every time. And at the end of an hour, you say, wait a minute, I just lost 15 points, 10 points, 15 points in an hour, and the bars are small. It's going to be impossible to make 10 points back this late in the day. So sometimes it's better not to take trades and forego the possibility of a big breakout, a big move. It's better to miss a good trade than to take a bad trade. If you miss a good trade, your account does not go down. If you take a bad trade, your account goes down. Psychologically, like intellectually, it doesn't matter, right, whether your account goes down on a bad trade. It's always going to go down on a bad trade, and you're always going to be regularly taking bad trades or trades that don't work. You're always going to have some losers. But if you're going to have losers, it's better to have them come from a trade that had really good math than from trades like this, where the math is not good. The reward potential here is small. And stops, the range is tight. Everybody uses tight stops. But if you're going to trade it, it's better to use wide stops. So if you buy, better to put a stop below 57. But then you're risking too much. So it's just very difficult to make the math work. It's fine if you can scalp with limit orders for a couple points, sell above the high of any bar, buy below the low of any bar, and scalp out 2 points, 3 points. But you're really not going to make a living doing that. It's better to just patiently wait until the market is starting to go up or down. The goal is to make money. The goal is to consistently make money. The goal is to consistently make enough money so that you have a career, that you can live off it, and live well off it. And the market is always tempting you to do things that make it impossible to achieve those goals. And you have to just be patient and fight the urge to take a trade thinking, a trade is overdue, we should break out any time now. Usually when the market rallies and then enters the trading range, it stays in a trading range for the remainder of the day. Remember I talked about this earlier. We have a strong trend. 20% of the time it just goes forever. 20% of the time it reverses, and 60% of the time it stops and you just go sideways. So strong trend, lots of bull flags, high ones and high twos and wedges. Yet the market never really rallied again. Same thing here. here the bulls do get pretty good trend resumption up. Here you get 3 bull bars closing near the highs, 4 or 5, a breakout, consecutive bull bars closing on their highs, closing above the moving average, and the second body completely above the moving average. So to me, that's by the close, and I would not get out below that bear bar. I'd get out, maybe below the first bull bar, maybe below that. Once the trend stops and you enter the trading range, it just tends to continue sideways. Here we got a new high, so a little bit sideways to up, but really not much profit potential. Once the trading range began here, we finished the day right around where the trading range started. Bulls trying to get a resumption of this. Can they get a close above 67? Can they get consecutive decent sized bull bars, 25, 26, or 24, 25, closing near their highs? It looks like we're going to reach that important price today. And we might, I guess we need probably one more bar to make me believe we're going to get there. But it's just not good enough for me to buy with a stop order above 69 or above 70. Stuck on the sidelines. If 70 and 71 both close on their highs with decent sized bodies, then I'll probably buy and take a chance. But I know the math. I know that once you have a strong trend that enters a tight range, usually it stays, usually it does not go up much, even when it tries. So we're trying to go up, but we're probably not going to go up much. The computers understand the importance of getting bars closing on their highs. The more bars that close near their highs, the more traders will believe the market is going higher. That traders and computers are buying into the close of the bar because they expect the next bar to be higher. Can the bulls give up and we get a really big, fast reversal down? That's unlikely. And can we accelerate up like 26, 27, 28? That's unlikely as well. And just look at the past 40 bars since bar 30. If you want to know what the next bars look like, just look at the past bars. And so, as much as I want to buy, I did not buy. I'm flat. And if you bought above 64 and get out below 64, when 69 went below 64, do you buy it again above 69? I think probably not. Good bar for the bulls. Now we have consecutive bull bars closing near their highs. Second bar, the body completely above the moving average. In fact, both bars completely above. So it's by the close, but I have to say I'm going to wait. I just know that there's not a lot of profit potential, so I'm stuck on the sidelines. I suspect I'm not going to take any more trades today. So what do you do if you bought the close of 70 or 71? How do you manage it? Do you get out below 72? Do you get out below 69? And this is what I meant by the math is just not good. You got too much risk, not enough probability to offset the risk, not enough reward to offset the risk. So better to wait. What happens if we get 3 consecutive bear bars? Does it sell or close? No, it's still a tight bull channel. It's still a small pullback bull trend. So the bears would need to get a couple bear bars breaking strongly below the moving average, and that is unlikely. And the bulls have a couple bull bars, 70, 71, closing on their highs, but they're small. And there's just not much energy. There's not much likelihood that the market's going to move far from where it is. So one of my general rules is if you have a tight trading range of 4 or more bars at bar 75, at 1245, I usually do not take any more trades. because the math is not good. 30% of the time you'll make money, 70% of the time you'll lose money, and the money that you make is not going to be enough to offset the losses. So it's usually better not to trade. If you have a tight trading range at 1245, and realize that 30% of the time you're going to get a pretty good move, 4 or 5 bars, but 70% of the time you're going to either lose money or make only a tick or two, not much. The goal is to make money, not simply to make trades. And sometimes it's difficult to achieve the goal. And in situations when it is, it's better just to wait. A bear reversal, 75, 4 consecutive bear bars, but they bought the close and they bought the moving average, similar to 68 and 56 and 50. But stop order bulls do not want to buy above 75, 4 consecutive bear bars. So yeah, they'll buy the close of a bear bar, they'll buy the moving average, but I doubt they're willing to buy with the stop above a bear bar. Limit order trading and limit order scalping. And for the past 15 bars, the range has been very tight. The range has only been about 6 points for the past 90 minutes. So most of the scalpers at this point are just trying to scalp for 2 or 3 points. I think it's better to wait for tomorrow. A bad stop order buy 75, so you'll have some bear computers selling with a limit order 75 high. Too little time left, I think. Better to wait for tomorrow. Remember what I said. If you have 4 or more bars sideways at bar 75, it's really difficult to structure a profitable trade, and it's better to wait and not take any more trades. And right now we have 6 bars in a tight trading range, and I think the math is just not worth it. Better to wait. Consecutive outside bars, outside up 76, outside down 77. A terrible situation for stop entry traders who are buying above bars and selling below. Really easy to lose a lot of money. Now, 77, consecutive outside bars, theoretically breakout mode. But as I said, if the market is in a tight trading range at bar 75, it's usually better not to do anything for the remainder of the day, even though we have an outside pattern. You can argue wedge 44, 71, 77, but I think the math is just not good enough. If you sell below 77, you're risking right now 8 points or so. And you expect to make 8 points in the final few bars of the day. I think if you're a computer and you can make quick decisions, you can do it. But an individual trader, I would wait for tomorrow. For the bulls, they're hoping 78 is a bull bar. They're hoping it's a failed breakout below an 00 pattern. But I would not do anything. I would not take the short below 77. I would not take the long above 78. Wait for tomorrow. Friday was, I think, a really exceptional day. We had a big bear day on Thursday. We totally reversed it on Friday. And on the 5-minute chart, I thought there was not a reasonable stop entry sell signal at any point during the day. You could argue this is a double top here, double top there, but it's 3 bull bars, so I would not short it. We had 4 bars with lows below the moving average. And every day, 99.5%, probably higher, of days have at least 3 bars with lows below the moving average. Here they came early in the day, and then the small pullback bull trend was exceptionally big, with gaps all the way up. Limit order bears could not make money. And that's really unusual for the market to go all day like that. And the limit order bears did not have a single reasonable stop entry sell signal. and they really had no ability to make money all day. If you sell at the high of a prior bar, it never came back below the prior high, so we had gaps all day. So that's an extremely strong bull trend day. Yes, it's climactic, and you'd expect a couple hours of sideways to down trading on the next day, today. And we had it. We were sideways here. We didn't break out until here. So, you can say the sideways trading ended bar 21. You could say 24. And then we started to break out 25, 26, 27. But basically sideways for a couple of hours. 75% of the time, if you have an extremely climactic day, the next day will have a couple hours sideways to down trading that starts by the end of the second hour. It sometimes starts at the open like it did today. 50% of the time, the market will try to have some follow-through buying, and it did, 4, 5, 6. And then we failed at yesterday's high and reversed down a low 2 with bar 2 and bar 6, but not a good sell signal, bar 6, 7, 8. Bulls gave up 9, a third consecutive bear bar, but it was still more likely a leg down in a trading range and not the start of a bear trend. Because if it's going to be a bear trend and it's going to be a higher high double top with yesterday's high, we would need a pretty good sell signal bar. And also, with Friday, as strong as it was really unlikely that we would go down in a bear trend without first going sideways for at least an hour or two. The bears tried to get a lower high major trend reversal, a double top pullback here, a credible candidate for the high of the day, but I felt that Friday was so strongly bullish that the bears would probably not be able to get much of a bear trend today. The bulls tried to reverse up 19 from a double bottom 11, and they tried to reverse up a second time 21, but a bear bar. However, bull bar 22, and they bought. Or they waited for the breakout above the moving average. So do you really miss much if you, instead of buying above 21 or 22, you wait to buy for 24, 25? Maybe you've got 5 points less profit, but the market still went up 25 more points. So I make that point all the time, that it's often better to wait for more confirmation that a trend is underway, even though you end up making a little bit less profit. The probability goes up significantly if you buy at the close of 25 or 26. You got a little bit more risk, but you still have a lot of profit. Starting today, we had a big gap down, and like I said several times, we had a big move up Friday, a big move down today, and that's typically going to result in a trading range. It generates confusion. I said it's possible you could buy above 1 for a bull trend from the open, but I thought we would enter a trading range. You could wait for 2 consecutive bull bars, with one having a big body and closing near its high. So you could wait for bar 2 and buy, or you can wait until bar 5 and buy. 2, I think you had room to the moving average. It's possible that the top of the range was going to be at the moving average. Instead, it ended up being at yesterday's high. And I said there would be buyers below 2. The bulls are hoping 1 would be the low of the day and the start of a bull trend. And that makes 3 a high 1 buy, but it's a pretty good bear bar. I'd rather take the limit order buy at the 2 low than the stop order buy at the 3 high. And 4, we have a big tail. The bears wanted a low 2 short at the moving average, a 50% pullback. From yesterday's high, we gapped down. This is a 50% retracement. But 3 bull bars, and nobody wants to sell below 4. And because nobody wanted to sell, they immediately bought the close of 4, and we got a bull surprise. We quickly went up to the next target. Yesterday's close, yesterday's high. We broke above it, and that was it. So the rally was a buy vacuum test of resistance. Yesterday's high, yesterday's close. And we sold off. But 6 is not a good sell signal bar. 2 is not a good sell signal bar. 7, 8, not good sell signal bars. So the reversal will probably be minor, and we'll probably try to get a second leg up. We got 5 consecutive bear bars, 11. For the bulls, higher low double bottom 3, but 5 consecutive bear bars, probably a minor reversal up. Bears will sell the 11 high. They'll sell more 5 points higher. The bulls got consecutive bull bars closing on their highs, 12, 13, but only one of them closed above the moving average. And after the 5 bear bars, it's still likely it's a minor reversal up, and that we'll have to test down to that 11 close area. The bulls had a high one, 14, but a bear bar. Plus, we know we're probably going to get a second leg sideways to down after the 5 bear bars. The bears have a micro double top, 15 and 13, and a bear bar closing near its low, 14, the neckline of the micro double top. And it's a credible sell for a possible high of the day, but it's probably a minor reversal. We had a good rally, 4, 5, 6, a pair of very good bars, 12, 13, and an exceptionally strong rally on Friday. When you have a day that is that exceptionally strong, you're usually going to get some follow through for at least a day or two. So the odds of a major reversal below 14 or 15 was small. The bulls tried to get an outside up double bottom, outside up 19, lower low double bottom 11, possible low of the day. And you can call it a parabolic wedge, down 14, pause 15, down 16, pause 17, down 18, reversal 19, but a tail right below the moving average. So if you buy it, you need a wide stop, probably better to wait. The bears got a low one, bar 20. They're hoping this is a bear trend, but the absence of consecutive bear bars at any point today, consecutive big bear bars closing near their lows, made it likely that the sell-offs were going to be minor. The bulls had that 2-bar reversal 22, a high to 18. You can call it a wedge bull flag with 14, 16, 18. A failed breakout below the wedge bull flag. We went below 19, reversed up. It's a high 2 with 13. It's a possible low of the day. It's still a tight bear channel. If you want higher probability, you wait for a breakout above the moving average. We broke out above the moving average 23, but not a very big bar. Did not close on its high. Probably better to wait for at least one more bar. And then 24, a high 1 and a possible bull trend, a bull bar closing near its high, a second consecutive close above the moving average, bull bar closing above the moving average, and a body completely above the moving average. So bulls will start buying above 24 and then above 25 and 26. And I said the bodies are starting to get bigger. So we're accelerating up, 24, 25, 26, 27, 28. Still by the close, but climactic, so we might pull back soon. 30, the bears wanted a bull trap, 2 legs up, 6 and 30. A wedge, 78, 6 and 30. But 8 consecutive bull bars. I said traders would buy the 30 low, not sell. I'm sorry, I'm losing my voice, and that's one of the problems when I talk 3 hours in the morning and then start talking later in the day. Excuse me. The bulls, high 1, 31. We should go higher, but 2 dojis and a tail, 29. It's possible that we'll go lower first. So if you buy above 31, it's probably better to use a fairly wide stop below a 50% retracement, and therefore it's probably better to trade small. The bulls try to get a second reversal down 34, but a bull doji, not a good sell. So it looks like we're drifting upward, but I think the market probably began a trading range with the bear doji 30. So whatever rally we get here will probably end up being a bull leg in a trading range, and then we'll get a bear leg in the trading range. So 35, 36, 37, all by the close. Possible wedge 38 with 30, 34. Reasonable to get out below 38, but 5 consecutive bull bars. More likely buyers below. High 1, 39, but I think we're going to try to get some kind of a wedge top. So I think we'll probably sell off before we get to that April, May high up here. But I think the reversal will be minor. Reversal 42, reversal 45, a 2-bar reversal, the opposite of 21, 22. I think we're going to pull back to the moving average. And at this point, we have, I think, whatever I said, 10 consecutive bull bars on the 60-minute chart. And I said the most I can ever remember seeing was 12. So therefore, I think we'll probably have a bear bar after 10 or 11 bars. And the bear bar came during the 12th bar on the 60-minute chart. We had 12 consecutive bull bars on the 60-minute chart. So the 13th bar was a bear bar. So anyway, I think we're probably not going to go a lot higher because I think we're going to have to get a bear bar fairly soon on the 60-minute chart. The bull's a high 147 near the moving average, but 2 consecutive bear bars closing near their lows, and different ways to look at the rally as a wedge. 37, 42, 44, or 30, 37, 44. We should get a couple legs sideways to down, and we should drop below the moving average. So I suspect there'll be more sellers than buyers above 47. A lower high 48, probably a minor reversal. I don't want to sell below a bull bar. Also, we've been above the moving average for more than 20 bars. Traders have been willing to pay an above average price. If they finally get an opportunity to buy at the average price, at the moving average, a lot of bulls will take it. So it reduces the chances that we're going to go down very much. And then a pair of bear bars, 49 and 50, closing near their lows, but only one bear bar closing below the moving average. 51, we have 2 bars closing below the moving average, but only one is a bear bar, so I'm not going to sell the close. We're probably still always in long. 51, a high 247, a 20 gap bar buy, a higher low double bottom 31, but only a doji bar after 2 bear bars closing near their lows, probably a minor reversal. We'll probably get more of a correction after the wedge top. The bears, 53, a possible lower high double top 48, but 3 bull bars, I don't want to sell it. 55, a bear bar, but now 4 consecutive bull bars. I don't want to sell it. 56, another close below the moving average, but 57 bull bar. So 51, 57, 57, I think was 1 tick below 51. So for the bulls, it's a lower, low double bottom, holding the moving average, but it's a doji bar, so not a strong buy. And looks like we began a trading range 30. 30, 58, closing above the moving average, closing on the high of the bar, closing at the 54 high, but then bad follow through. For the bears, 59, they want double top 54, but I suspect there'll be buyers below around the moving average, so I would not take the short. And 60, it's a high 1, so it looks like this might be a small pullback bull trend. I think there probably will be sellers around the high of the day, and I'm very confident there'll be sellers up here at that April-May triple top. So I don't think we're going up much. And I also said that I thought the 5th hour today would have a bear body. So I thought the close of 60 would be below the open of 49. And I think it was like 1 tick below. So small pullback bull trend 60, but the top half of a tight trading range. I think you can take it and hope that we break strongly to the upside. But usually when you get one of these really strong rallies and then it starts to go sideways, you're going to stay sideways for the remainder of the day. So I don't think we're going to go up very much. High 164, same thing, top of the trading range. We might get to that April 28th high, that triple top up there. Might even get a little bit above it, but I don't think we'll go much above it. And that's only 5 points up, so not a lot of profit. Upside down, 67, but a doji bar, small pullback bull trend. They've been buying the moving average, so I don't want to sell it. And then a high 169, but a tail, 8 bar, 9 bar, tight trading range. I'm not going to buy it. It's a limit order market. A pair of bull bars, 70, 71, closing near their highs above the moving average. You can argue by the close, and it is, but I don't think there's a lot of profit potential. And then 72, a disappointment bar, bad follow through. And 73, another bear doji. So it looks like now the bulls have bought the close of 71 are disappointed 72, and they're desperate to get out break even, and they can't even get back to the 71 close where they bought. So I would get out of longs if I were long. I was not long. It's flat. You can get out of the market. You can get out below the low of bar. You can put a stop below 69 or below 57. But small pullback bull trend, negative above, a weak rally. We're probably going to have a hard time going much higher. 4 consecutive bear bars, 75. High 1 at the moving average. They bought the close. They bought the moving average. But I'm not going to buy 76. Remember, If the market's in a tight trading range at bar 75, it's usually better to wait for tomorrow. Outside up 76, outside down 77. But how much money do you think you'll make? You're risking, what, 8 points, 9 points? Are you going to make 8 or 9 points? Probably not. Is the probability that you're going to make 8 or 9 points 60 or 70%? Probably not. And therefore, you should not take the trade. Stop entry trading today, above 1, reasonable, not great. Above 2, reasonable, not great. And then next after that, you could buy above 19, but I was concerned that tight channel and tail right below the moving average. And then you could buy above 22. Or if you want higher probability, buy above 24, 25, 26, 27, 28. We're probably going to get some profit taking soon. You could buy above 31, but I'd use a wide stop. 37, you could buy above 35. I'd put a stop below 31. You're hoping for a small pullback bull trend. Buy above 36, above 37. You could get out below 38, but with 5 bull bars, I think you could get out several points below 38. And then high 139. I originally bought the high 139, and then I decided it was stupid. I got out break even. I decided it was stupid because of the wedge. So I thought we might race up to the blue line, but then I decided, I don't know. This is looking pretty weak, so I exited. Bears, they could sell below 43, looking for a couple small legs down, but I think they'll have a hard time making more than 5 points. They'll be buyers at the moving average. And you could buy above 51, I would not. 52, I would not. 57, I would. It's a second reversal up. 58, you could, but then you're disappointed. 59. If you bought above 58, I would not get out below 59. I'd get out below 57. And then once I saw 59 as a bear bar, I would change my approach. I would get out with either break even above 60 or looking for a small scalp, 2 or 3 points. And that would be it for stop entry trades. Limit order trades, high probability buyers below 2. We had a huge bull trend yesterday, and then we have 2 bull bars today. We should get to the moving average. And what about buying below 6? Well, we just tested yesterday's high. We're likely to have a trading range open, and it's a second reversal down 4. So I would not buy the 6 low. The 11 high, it's 5 bear bars. You could sell it, but you need to stop above 6, and it's better if you sell more 5 points higher. 14, probably sellers above. And then can you sell above 18, 19? I would not. I think we're at the bottom of a developing trading range. Could you buy below 20? A bad sell? Yeah, I don't know. I probably would not. And then then sell below 30. Yeah, a really high probability that you'll make 5 points if you buy the 30 low. I bought the 30 low. Can you sell the 32 high and bet we'll get a micro double top? I would not. You could probably buy the 34 low and take a chance that we're going to get a channel up from here. 38, I'd get out of longs. I would not buy the 38 low. 43, if you're aggressive, you could sell above 43 or even above 41 if you can use a wide stop. I would not buy above 47, but I would also not sell above it. 54, 4 bull bars. I think it's a minor reversal in a tight trading range. You could probably buy below. And 62, maybe buy below. But the bars are really small. We're spending a lot of time sideways. Probably better to wait for tomorrow. If you sold the 75 high, you'd probably put a stop above 72 and you got stopped out. But overall, a good day for the bulls. Overall, a good month for the bulls. Really strong bull trend. You can argue 3 legs up, 1, 2, 3 in a sell zone. This triple top. And as I said, there'll be supply here. The bulls who bought here never had a chance to get out break even once we sold off. And some of them bought more lower. And the ones who bought more lower are looking to exit around here. And traders who simply bought down here know there are bulls looking to sell here. So we'll probably pull back in the next day or two and start to go sideways for a few days. I do think we're going to reach the bear trend line. It's possible that we pull back to 4,000 before we do. I think there'll be buyers below around 4,000 and around a 50% retracement of this rally. At this point, I'm not sure that we'll reach this breakout point, we might, it's just a little bit below 4,000. But I think we've seen the low for the remainder of the year. I know you got everybody on television talking about how this is a bear rally and that the bear trend has not ended. But I think it has. I think we're in a trending range. I think we've been in a trending range for more than a year. Trading range probably began somewhere down here, or up or down. We'll probably go up again. We'll probably go down again. But I don't think there's a lot of downside risk. It's possible China will invade Taiwan. It's possible Russia will drop some tactical nukes on Kiev, trying to decapitate the leadership. And either of those things, the market could sell off. It's possible some other surprise will happen. Usually the predictable surprises don't happen. And the two obvious ones are the ones that I just mentioned. So, I don't think they're going to happen. And they may already be priced in. So if they happen, the sell-off might just last 2 or 3 days. Okay, a question about yesterday. Usually I really only want to answer questions about today because otherwise, it opens up too much stuff. And anyway, yesterday opened with a tight trading range, and then bar 16 was a bad buy signal bar. That's correct. There were tails and bad follow-through on all of the breakout bars. When do you ignore all that and see the trend as the dominant feature? When did the probability change? Whenever I see, obviously, I'm thinking, we're breakout mode, so I'm looking for a breakout. I see that we've hit the moving average 4 times on bar 16, and we're not closing below the moving average. So it's breakout mode, but I think up is more likely. And at some point, the aggressive bulls would buy above 17 or 18. I'd like to wait for clarity. 19 was an attempt at clarity. It broke above but closed below the double top. So, and 20 is not a very good buy signal bar. So for me, I thought if you're looking for the highest probability entry, I'd wait for the close of 23. 22, we broke out. It's possible wedge with 10, 19, and 23, but we have a breakout 22 and a bull follow through bar 24. So I think it's reasonable to buy there and put a stop below, 22, stop below 20, or you could wait for the high 2 at 29, which is basically the same price, and that was a higher probability buy. And the advantage of 29 is you can look at 29 and you see a breakout 22, and what did it break out above? It broke out above 19, and you look across here, and what you notice is that it's a breakout test. And let me just check something here. Okay, yeah, I thought, I was just confirming, the low of 29 is exactly at the high of 19. And so for me, that's a green light going up. I said, wait a minute. So the limit order bears that sold the 19 high were unable to make money. They sold more 5 points higher during 26, and they needed it to drop below 19 for them to make money, and it did not. And we got a good buy signal on 29. So to me, I'm thinking, we broke out on 19, and then we broke above 19, and the limit order bears, it's a pretty two-sided market here. Yet, even with the two-sided market, the bears were unable to make money. So my thought is this is a second breakout. This one, the limit order bears are trapped. This could be one of those small pullback bull trends that last all day. So then you just turn on Forrest Gump mode. Every time you see a bull bar closing near its high, if you're flat, you just buy it on a stop. If you're long, you can add on all the way up. Anytime you see a bear bar, you just buy the market on the close of the bear bar. And then you get confirmation. You have other gaps, 39 low and 26 high, and 49 low and 38 high. So you keep getting confirmation that the bears are getting screwed. So nobody's going to want to sell. That means there are only buyers, and we're going to go up. Okay, question. I passed on 22. That's reasonable. just below the moving average, and 21 was a bear doji. Also, I passed on 24 due to the tail on 23. That's okay too. And okay, but at the top of the triangle, possibly 2 legs sideways up. Yeah, he's saying he didn't buy here, he didn't buy 24, but I think most traders they could wait for 25 or 26 and then start to buy. I don't remember which trades I took. I was talking when I talk. I'm not. I'm taking trades. I'm not taking as many trades as I take when I'm not talking. And a lot of times I'll enter at the market. And, so I bought the rally. I don't remember where I bought the rally. I probably bought late, probably during 26. and then up here I bought the 30 low. I remember that. And I took some of the high run buys, maybe about 35, 57. And I took a short somewhere up, I think somewhere in here, betting that the hour would close below the open of the prior hour, below the open of the hour. And then over the past hour, I did nothing. I did nothing in here. Okay, question. I know you like to get out early. Can you give an example of where you would rely on your stop and sit through the pullback as opposed to getting out early? Yeah, buying the 30 low. To me, that's one of those hodl type trades. You hold on for dear life. So I buy the 30 low. I'm probably 80% confident, at least 70% confident that I'm going to make 5 points. And if it goes down, I'll buy more 5 points lower, 10 points lower. I probably would buy more 15 points lower if it went straight down. So that's an example of a wide stop. Okay, question. In the course, you mentioned that waiting for the end of a bar is the way to trade, but you often speak about taking trades during a bar. How do you decide when it's appropriate to take a trade during the bar? If I think the context is very good for a trade, a lot of times I'll enter early, especially if I'm talking. But most traders are better off waiting for the end of the bar. But when you see 24, 25, 26, the body's getting bigger. 27, another big bull bar. So 26, 27, big consecutive bull bars closing on their highs. You can buy on a stop above 27. You just buy the market. If you didn't buy and 28's going up, it's going to go higher. So you just buy at the market when it's forming. But most traders should just wait for the close of the bar, 26. And if they're flat, they just buy the market or put a stop and buy one tick above 26. So most traders should just stick with the stop order trading. But a lot of times stuff happens really quickly, and I'm very confident that the market's going to race to the next support or resistance level, and I don't want to wait for the stop order trade. And sometimes I'll put up a 2-minute chart. Talk about that. Sometimes I'll put up a 2-minute chart here. I didn't look at the 2-minute chart today, but sometimes in a really strong trend, I see the first bear bar, I'll buy the close, or I'll buy with a limit order at the low of a bar. But I did not. Most of the time, I don't look at anything other than the 5-minute chart. However, if I have a lot of energy and I don't have any distractions coming up for the next hour or two, and I'm not in a chat room, sometimes I'll put up a 2-minute chart and scalp. And how would I scalp it? I like to trade in the direction of the trend, and I trade just like the 5-minute chart. If I think it's going up, as soon as the bull bar closes, I'll buy on a stop above its high, or just buy the close. Buy the market, buy the market, buy the market. Bear bar, first bear bar in a strong trend, buy the market. And scalp, try to scalp out for 5 points. If the bars are small, I'll scalp out for less. I tend to scalp out for smaller profit on the 2-minute chart if I'm entering with closes or at the market, because the bars are smaller. But if I'm doing it on the 5-minute chart, usually a small scalp is 5 points. On days when the day's range is 60 or 70 points or more, then a scalp is usually about 10 points. Okay, hope everybody has a good night.